Assalamualaikum warahmatullahi wabarakatuh. Selamat siang. Semoga sehat dimanapun Anda berada. Selamat datang di PAI-SOA Joint Webinar 2022 Digital Transformation and Artificial Intelligence. Terima kasih telah bergabung. Perkenalkan, saya Yosep Kusuma Wibawa. Di sini saya akan bertindak selaku host dalam webinar hari ini. Untuk webinar hari ini kita akan menggunakan bahasa Inggris sebagai media komunikasi. So let's start our webinar. First of all, I would like to inform again the rule of conduct for participants. Number one, please rename with the format number hyphen name. Later on, we will share the attendance list via chat, so please fill it. And number three, during the presentation, please turn off your camera and microphone. And then you will have the opportunity to submit question to today's presenter by typing your question into the chat box. And you may send in your question at any time during the presentation. Your question will be collected and we will hopefully address them during the Q&A session. And at the end, there will be a documentation session, and it is hoped that all participants will activate their cameras to take pictures together. So to start our webinar today, we will have an opening remark that will be addressed by the Chief of Persatuan Aktuaris Indonesia. So let's welcome Bapak Ade Bungsu.
Terima kasih Pak Yosef. Assalamualaikum warahmatullahi wabarakatuh. Selamat siang, salam sejahtera semuanya. Good evening to all the participants. Thank you for your joining this joint webinar between SOA and PAI Persatuan Aktuaris Indonesia. I think this is the second joint seminar that would like to have the joint session among the two societies under the actuarial societies SOA and Persatuan Aktuaris Indonesia. First of all, would like to thank you to all the speakers that have the time and would like to contribute, giving their sharing their knowledge to this program. Yeah, I think this is the good session for both of us, and I can see the participant not only from the member of the Indonesia Society. I see some coming from several outside the Indonesian country. So we're coming for those joining this session. So I think once again, thank you for your participation, enjoying this joint seminar. I think the topic is very good. This is about the artificial intelligence and also the transformation. This is something that most actuaries need to be updated, not only about the actuarial issue, but also any other issue coming from the market development, the environment development, and also other sectors. Yeah. So thanks you once again. Enjoying this session, and good luck all. Thank you.
Yeah, thank you very much for your words, Bapak Ade Bungsu. So now it is my pleasure to introduce to you our next presenter to speak about current events in actuarial technology. Our next presenter is Del Hall FSA MAAA CERA CFA. He is the Managing Director of Research for the Society of Actuaries. In his role, he coordinates the SOA Strategic Research Partnership, oversees SOA experience studies, coordinate research across the SOA's wide variety of actuarial practice areas and markets, and direct the SOS data-driven in-house research initiative. He is a frequent speaker at insurance and retirement industry meetings to highlight SOA research. To speak about current events in actuarial technology, let's welcome Del Hall. And for your information, the session is in the form recording, so in case there are questions, we will coordinate with speakers and send the answer via email later on. Let's begin the presentation.
Well, welcome everyone to this joint seminar between the Society of Actuaries in Indonesia and the Society of Actuaries, focusing on digital transformation and artificial intelligence. We're going to be focusing today on these types of topics. I think some really exciting opportunities in the actuarial profession for these types of topics. For those of you who haven't met me before, I'm Dale Hall, Managing Director of Research at the Society of Actuaries Research Institute. I'm going to be talking to you a little bit about these current events in actuarial technology, show you some of the research projects that we've been working on. And I think they're helpful, if not for just introductory primers, but also giving you a little bit more detail on things and also setting the stage for what I think are some really interesting and forward-looking actuarial opportunities, whether it's inside your insurance company or maybe your reinsurance company or being in a consulting actuary or really working in any type of place or organization that uses technology. Some really, really helpful things to do. So let's get moving forward on that. Of course, we want to make sure that we're following the antitrust compliance guidelines that I'm showing on the screen as well in this presentation. And here's this presentation disclaimer as well for the benefit of the people attending the meeting. So let me give you a brief overview of what we do at the Society of Actuaries Research Institute. Core to the actuarial profession is doing actuarial research that we can use every day in our work as actuaries. And the core mission of the Society of Actuaries, when it was actually formed back in the 1940s, was definitely to do a lot of research. Organizations that preceded the SOA came together and said, look, we want to do some experience analysis. It'd be helpful if we all pulled our information together. And so, to avoid doing that in an antitrust sort of way, they formed the Society of Actuaries to gather all that information together and do an experience study. It was very beneficial to the life insurance industry in the US and at times around the world. And at that point in time, we have done since then a variety of different projects. So of course, experience studies is still core to what we do at the SOA in our research institute work, studying and collecting information across different lines of business. We've expanded from individual life in the United States to lots of different products and contingencies, whether it's lapsation or policyholder behavior, whether it's a life product, annuity product, disability, long-term care, even now retirement pension mortality, and actually even more outside the United States, North America as well. US and Canada certainly in the main place where we're doing some of these studies, but a lot of experience that we've done in partnering with local organizations in recent times, for example, with the Chinese Actuarial Association studying life insurance mortality in that particular market, some more in a Caribbean setting where we're doing pension scheme mortality there. And it always seems like we have some new ideas going on or working with local markets as to how we can help study different types of product experience. So even if there's things in the Indonesian market that you'd like to talk about further, feel free to connect with us and then we'll see what types of projects might emerge there. We also have what we call practice and in-house research projects. These are papers that are a little bit more thought leadership, or maybe they're on a current topic that we're studying, what's going on and how it applies to actuaries in the world around us. I think you'll see some of that in our demonstrations today, talking about those types of projects. We have a variety of committees that either have funding or maybe they work with outside partners also to sponsor these types of projects. So there's a lot of different practice areas because actuaries are working in a number of increasing practice areas. And maybe one that I would like to point you to, a link at the bottom of the screen is our new research link. Every couple of weeks, we'll go out and populate that specific page with new things that we're releasing. Of course, when they are released, they're more in categories, of course, in their practice area topic, but then we compile them all together and highlight them on this new link. And we say, here's 3 or 4 or 5 new things that have been released over the past couple of weeks. So maybe a good thing to know about or to go on the internet and save it as a favorite and kind of double back to it periodically. And the Research Institute, we have on the right-hand side of the screen here, these 6 strategic research programs. These are programs where we do a lot of work, and as you might imagine, they're in practice areas that for the most part have historically been where actuaries have worked across history. They're in retirement and longevity and mortality and healthcare trends. And especially in some markets, I guess the way the healthcare is distributed, it's really important to follow those trends like here in North America. But I also think there's some things on here that I wanted you to point to. We're always looking to study, more forward-thinking new things. So a lot on innovation and technology. I think it's great that we have this type of webinar series that's highlighting much more of that, the digital environment, artificial intelligence. We've certainly ramped up our work on those types of topics in recent years. And also on diversity, equity, and inclusion. How does insurance and financial services mix in with the desire to create access for all types of people across all races and genders and ethnicities and things like that? And what are the contingencies to be aware of? And how do we do this type of insurance and financial services equitably across the full population? And then we're also focusing a lot more on catastrophe and climate. It's a growing place across the world, focusing on climate risk. And how does that impact our financial services and insurance industries for sure? What are some of the big events that are happening through natural catastrophes, but also man-made catastrophes, terrorism, cyber risk, unfortunately, things like that are really important for us to study. And then on the left-hand side of the screen, you even see a deeper dive down on our website to the variety of topics that we cover through research and communicating it out. Here's a couple ways that you can kind of keep in touch with the variety of things that we do. We certainly have a Research Insights podcast where about once a week, maybe 3 or 4 times a month, we push out an interview with one of the researchers on a project that we've released. You can find that on any of your favorite podcast players, or just go to the SOA website and you'll find it there as well. Trying to do a little bit more also with data visualizations. I think we know that as actuaries, just pushing out a paper in the form of a PDF it isn't always as valuable, given some of the data that's behind the analysis that we've done, and allowing a user through Web Tableau to look at it through some of the different mixes or matches of the data. It's really helpful to do it in that way. And then trying to do a little bit more, get in the sight line where more of what's going on and the way people follow news in the world. So whether it's on social media, whether it's through different professional development opportunities, starting to do a little bit more video to highlight our interviews with researchers, the impact that it might have on the actuarial profession. We have a channel on ActuView. So if you have access to that, we routinely push out a series of videos highlighting what's going on in our research work. So let's start then, with this concept of actuarial innovation and technology. Again, one of our strategic research programs that has been really important. It's really just amazing to see how in recent years, especially, there's this growing importance in this intersection of where technology and where actuaries practice are all happening. I mean, clearly back to the origins of actuarial science and the origins of the actuarial professions, we've been doing lots of different calculations, tabulating numbers. And of course, back in the day, that might have been first on paper, on columnar pads. Eventually, the concepts of computer power and computer programming and spreadsheets came around. So there's always been this continuity and interaction between the actuarial profession and technology, but that's just kind of exploded in the last 10 to 15 years with the advancements in technology and computer power, the advancements in what's going on with data analytics. I mean, even in my time in the actuarial profession, we've gone from where I was submitting things to, a remote computer being processed somewhere remotely because we didn't have enough computer power in our office to do that, to now where in the palm of your hand, it seems like there's infinite computing technology and power, and using that to bring a whole bunch of the calculations needed for data analytics, predictive analytics. And where are these type of correlations and what types of decisions can I make or risk assessments can I make? Technology is clearly one of the engines that is driving that forward with what's going on in the actuarial practice. So we've decided that's really a place where we need to provide more information to actuaries. It's also a place where we're taking that knowledge, and actuaries are using it in a wider field, a wide array of things outside the normal insurance and financial services arenas to provide more analytics and more decision making and risk analysis. There's even a new vocabulary, new words that have evolved here. Clearly, you might know the word insurtech. That's a combination of insurance and technology. Also, often thought as some startup companies that will pull together an idea and build on it, or maybe they'll use it or sell it as a service to the insurance industry, whether it's in underwriting, whether that's in risk assessment, might even be on the property casualty side, places like claim adjudication. I'll take a picture of a damaged vehicle. I'll assess what the damage is through some visual recognition software rather than just sending a human adjuster out to do it. And all these different applications are uses of that type of technology. And they're making a difference for sure in the insurance operations of the world, making it more efficient, making it easier for insurance companies to efficiently provide these types of benefits and services. And then we're on to DeFi, and we'll get into a little bit more of that as well, or decentralized finance. It's becoming more and more common, often equated a little bit with the concepts of, say, stable coins. Probably the most common of those is Bitcoin, or through blockchain processes, technology that is out there to enable those types of transactions. Just a lot of opportunity, I think, even beyond those introductory type of concepts for decentralized finance to be growing as part of the insurance and financial services sector. And actually, ways that actuaries are getting much more deeper involved in all that. So we'll take a look at that here in a minute. At first, I wanted to focus on this concept of, current and emerging technologies. Certainly a growing place where actuaries are becoming every day the bigger decision makers or the strategists. So, they're the ones who are putting into place in their companies the way technology is being used. And again, whether that's an insurer or reinsurer, a consulting firm, and across all practice areas. So what we at the Research Institute did was said, we really need to capture more of this through good thought leadership, this knowledge. We've created an industry expert management panel that we assembled. Some of them are, we've done this now a couple of times to discuss what are the key things that are going on in your practice area. We asked them, what are some topics that, in an antitrust sort of way we could share and kind of learn from each other a little bit. And the first of those reports you'll see in the link here. We published that right around the start of 2022, and we've been following that up with another session just recently in the spring of this year, and recently published that report as well. And I think there were three or four macro issues at the start of these conversations that we noted that actuaries were continuing to realize and face on a consistent basis. And we've listed them here. Clearly, one is that of data management. It's ever expanding. There's more and more data coming in. How are we going to handle that regardless of what industry you're in? We're always expanding what new data we can bring in, and how can we manage that data and put it to good use? And so the question there for sure is, how do I choose the right tools that can do that? How do I, use those tools effectively within my department? Which ones do I choose? What makes sense given the types of data structures that I'm working with? Can they interact with each other? How do I create this kind of huge repository of data within my organization and then use it in the most effective way by combining the right ideas, the right technology, the right people, the right analysis, the right interactions, all that, even across different departments in my organization to make really good decisions. And I think even this environment, we heard through that conversation and voice as well, that training and onboarding of new people and new technologies is another struggle that people are trying to overcome today. I think they're overcoming it well by putting some definite strategies in. I think in some cases they're doing it pretty effectively, but we know we have like a new labor market as it is. And as we increase the use of data, how do we find the right talent, the right people, mesh it together with the technology that we're using? And if I choose to create a new analysis, a new tool, some new data sets, how do I make sure my really strong human resources work well with all my important technology resources on new things that I'm trying to do, or new things I'm trying out, or try to continuously improve the way data gets analyzed. More actuarial technology has this importance. It also heightens the importance of good coordination and cooperation, this interaction with others. I'm really glad at the SOA we've got a growing set of professional development opportunities that are in the shape not only on technology, but how do we communicate technology effectively? These leaders that we talked to said that's a really important and growing skill set that actuaries need to hone more. How do I interact with my information technology peers, or how do I interact with people in the marketing department, or people in the claims area, people in underwriting? If I'm an actuary, to make sure that we're all on the same page when it comes to effective use of technology, that we're communicating right, we're doing cooperation and coordination the right way. How do I make sure I, as the actuary, at least try to center us all effectively on the same page? How do we make active decisions together? A really important issue that we heard from our expert panel. And then thinking even more from these folks, the people that we brought onto this panel, was always kind of thinking on what's on the horizon, what's the next technology state I should be thinking about, identifying what's coming, what tools are emerging, what statistical analyses can be beneficial for us to bring into our organization, and how do I stay on top of it? How do I keep in tune with that on a regular basis? I might be so buried in my efficiency of my operations that I'm failing to see a lot of things that are new and maybe spinning right outside my sight line. So how do I mesh together that something new with my current in-force set of technology, and piece that in layers, or find a way to upgrade or replace? What's my flexibility to make sure that can happen effectively? I think as well, as we talk to the expert panel, one of the main things we'll see on the next 3 slides were these discussions that are going on all around us as well, different impacts that they're focusing on. Clearly one was on data. These are some of the trends listed here that they're seeing as they identified in our expert panel sessions. There's a clear move to augment data structures that we have traditionally used, that we might consider a little bit more traditional, a little bit more just normal actuarial experience knowledge, into new things. And especially this might come true in underwriting. Historically, we might have said there's just some numbers that we follow, a body mass index, things like that, or it may be in the old world, just an experience study that we've done. But the great thing is we have so much opportunity to capture data. There's always new things coming in. There's always new lessons that can be learned beyond what I'll call just normal actuarial analysis experience. For sure, we may still want to study past mortality trends that have been by age and gender and underwriting class and things like that. But how do we now layer on some new data structures? Some of them may be numerical, some of them actually may be different data kinds, visual data, photographic data, purchase behavior data, of clients. Are there any indicators of what we can learn more about what the future may hold by looking at the type of data that we're collecting internally in our organization? A corollary is certainly that there's more data from different places, even outside the actuarial function, that's ever available. It happens to be really valuable at times. Again, it's often in some non-traditional structure. It may just not be a zeros and ones or a yes or no sort of thing. It's a broad history of information about risks and attitudes and behavior. And how can we effectively use that, not only to kind of glean what might happen with our in-force block of business, but also to potentially use it for new opportunities, new sales, new products, things like that. I think the data also in our group was saying, hey, you've got to identify the right data platforms and kind of make sure that they're well governed. If I'm coding in this particular program, how can I make sure that the code is tested and approved? I'll admit that there's probably some aversion to that, but necessary. How do I lock it down and make sure that even if I do some fiddling along the way, I need to reopen that code back up, create the next version? Maybe this is now version 2.0, what's the right governance, what kind of information might I need for a regulator or an insurance supervisor who might come ask me about the model that I ran that produced some numbers for a financial statement. And then on the data side, clearly how things are stored. I mean, I think we're all in this. It's the moment of basically moving everything out into a cloud environment, trying to make it more efficient. It certainly reduces my cost to have to buy more and more physical storage for all this data. But now I can kind of rent that in the cloud or use it that way. Or maybe I have a dedicated cloud space. I have to evaluate what are the pros or what are the cons. What risks do I need to be aware of where all these common themes are coming into actuarial data? That's what's going on. It's pretty amazing stuff. The tools are also kind of what we focus on here. Another part of the equation, definitely on actuarial tools. I have to admit, I'm kind of a nerdy technology guy myself at times, and I think I have everything understood. And all of a sudden, we bring in this expert panel, and I realize I probably even only know about half the full story there is. It's an amazing and complicated diversity of analysis and actuarial tools that are available. So of course, we've migrated from these spreadsheets to databases to using analytics, R, Python, different SQL, inquiry codes, things like that. And really the most successful actuarial managers, they have to be in on this understanding of the diversity of all these tools early. They need to know, how do I bring these together, this potential wide array of tools all to one place to be effective? How do I judge and say, well, that's a pretty good tool, but it may not be the right fit for this particular analysis or purpose. And let's not reduce our efficiency by throwing something else into the work. How do we generate parsimony among the tools that we have? Of course, change management is a big part of this for sure. How do I change to a new tool as I'm updating my models? How do I put good governance around that? And there's also kind of a change of people. I want to leverage off our most knowledgeable assets within our organization. But really, that star employee that I have, he or she can only work on maybe one or two projects at a time. And the best managers will ask the question, how do I use that? And then train others to learn what that star employee might know. How do I make sure I'm passing that knowledge on to others across the organization and maximize the opportunity? If I have a change in the pieces that I have, the people along the way, I'm giving new people some new opportunities. How can I make sure we're all speaking the same language and we're all coming from the same corporate philosophy? It's definitely a challenge, because everyone was educated in different places, or maybe they had their training or first years in the actual profession in different places, which is really good. We need to bring a diversity. It's a diversity of ideas, a diversity of backgrounds. We just need to make sure, and this message came through in our panel, as we are leaders in this data analysis, that it comes together with a common purpose. And of course, open source and data security is always part of it. Open source especially. I mean, it's great that people can kind of go into programs, maybe tinker, update, change, but you need to be able to read what's going on through a calculation. Hopefully it's not just all a black box, but is that method the right way to do it? If you need to do it consistently, can you keep track of all those open source changes? Certainly something that managers we talk to are thinking about. And then, the broader philosophy here is through that of actuarial management. There's always this concept of developing the right actuarial operating model. It may be different for different firms. How do I make use of my actuaries? And really, what's the right interaction between actuaries and data scientists and marketing professionals and other operational professionals who know about how to work with consumers, or medical professionals who know how this all might fit into our underwriting process? So really a lot of time and effort needed to focus on what is the right actual operating model? How is that going to be working well for me? And then integrating those technologies and strategies across many, many different lines of business. I have to believe that insurers in Indonesia are not just writing strictly one line of business and that it's narrow focus. I think there's lots of opportunities in lots of different lines of business. So it might be across property casualty and life and health and disability and long-term support services, all types of things that there are, good operations. And and we'll try to have a model strategy be consistent across these different lines of businesses. Not only so there's a common philosophy, but also if you want to integrate them up and look at a full risk management across your full enterprise, it's important for those things to happen that way. Or even in a consulting office, if you're jumping from project to project, you certainly want to have at least a consulting office strategy as this is kind of how we're going to do this type of project. So when the next project comes up, you're not starting from scratch. And more of the management too is focused on vendor risks as well. So if I'm trying to do some sort of digital transformation, if I'm trying to build some sort of new artificial intelligence into my operations, I may choose some vendors to assist me with that. But what types of risk is there? Are those vendors going to be the same ones that are around in 2 or 3 years? Are they going to be purchased or bought? It seems like there's always some sort of active engagement in the insurtech world of buying and selling these different types of units and components. And if for some reason I need to go on and choose something new, or the support for something that I perhaps chose in the past is no longer there, how do I make sure that I'm looking at these types of things across our broader actuarial management in a way that's reducing my risk by being just tied to one vendor or 2 vendors? So at that, helpful information in that report, I certainly encourage you to go take a look at that. That several things that have been posted. I think it's something we'll do recurrently, is to bring together our innovation and technology experts. And believe me, if you'd like to join us on that, feel free to shoot us a note. I think we're trying to get more and more people in that conversation at times. I think it's really helpful to get a diverse set of information. So let me flip with that into a new concept. This is decentralized finance. Maybe not new overall, but we certainly have seen the headlines and the terms becoming a little bit more and more common in our vocabulary. I think the question at times too is, well, what does this all have to do with actuaries? And I think the answer tends to be, maybe more than you think or even realize. There's a lot of evolution that seems to be happening here. I don't doubt that we'll wake up someday and actuaries are in the center of even more of what's going on with decentralized finance, or DeFi. So maybe just to level set for a second, we created a research report, a little bit of a primer and thought leadership on what is this concept of decentralized finance. And I've included some of the links on the screen here for you to go take a look at. We'll provide those as well, or you can put those into the chat or even provide a PDF of these slides. I think decentralized is kind of the key term here. And there's a few things early in the paper that say, well, here's some either leading definitions or characteristics. And let's see what we mean when we look at the whole spectrum of what decentralized finance really is. And number one is it's definitely makes an attempt, and I think successfully well at times, to become disintermediated. I mean, a lot of financial transactions that happen around the world today, there is some sort of intermediary that's there to deliver the services. If I want to, say, invest in a company, I likely, first of all, will be taking dollars out of my bank account. So there's at least one intermediary there from the start, my bank. And then I'll go turn this over maybe to an investment firm, another intermediary, who might then perhaps go to a stock exchange, for example, or a mutual fund exchange, another intermediary, and then ultimately, purchase the shares in this mutual fund or this company. So instead of it just being a transaction between myself and one company or a group of companies in a fund, there are always these other intermediaries that are there to deliver services. Well, decentralized finance is trying to say a little bit more. Let's try to disintermediate this a little bit. How can we use technology and minimize the number of intermediaries that are needed? And smart contracts, or the concept of blockchain and smart contract technologies that provide those services, are part of that, without having all these intermediate steps along the way. Are those intermediate steps kind of causing friction in the process? Are they causing costs to be higher just for the process to occur? I think that's what's at the heart a little bit of decentralized finance. Is an ultimate goal is to use technology to do that disintermediation. It's also decentralized. So, the technical infrastructures of DeFi and many of the governance processes are run by decentralized places. that being decentralized, lessens the risks of everything having to go to one central point, there being a central point of failure, which helps, doesn't help anyone. If that central point of failure happens, then maybe lessens the risks of uncertainty as well. The more things that are decentralized, there are things that can be avoided. I mean, in its foundational form is we can decentralize and make a transaction happen anywhere through a blockchain technology, this computerized technology exchange process. Those transactions can be verified and added. You can combine together two things together in a much decentralized manner. The second is concerning like on-chain activities. There's different protocols that can emerge where it becomes much easier to understand and more standard to understand how those transactions are happening, and that's very helpful in the process too. I think one thing that is pointed out in the paper too is the decentralized finance is sort of permissionless, or that's the goal. It certainly has a goal that everyone has an opportunity to participate in DeFi. Maybe a minimum requirement is access to the internet, computer power technology, bringing people together and things like that. But at least, with some minimum form of capital as well, the goal is to make sure that these transactions, typically through public blockchains, they're really open to anyone. And through that, it kind of implies that decentralized finance is open to anyone as well. It becomes a little bit more borderless at that point as well. We could be transacting from here in the United States to Indonesia. It's a little bit more straightforward. Maybe it helps reduce barriers to entry. That's often pointed as one of the benefits to decentralized finance as well. And while blockchains and smart contracts are truly kind of permissionless in theory, there might be a few hurdles. How would you want to know how your client maybe gets their identity verified, or some financial institutions, they may disallow users from sending assets to other outsiders like cryptocurrency services if they can't be identified in some shape or form. But the concept in theory, I think, is a good one, and working on the downside of that all the time. One thing we do and get together and mesh it together with supervision is probably a question too, but that's the beauty of the ultimate goal, is that everyone can participate. Also, it's often thought as composable. These decentralized finance protocols can really interact with each other. They can build beyond just a first purpose. They can be built on top of each other. So you can see all the distinct steps along the way, break them down into their component parts. And maybe because of that, the goal is also to be transparent and immutable. Transactions and balances are things that you'd want to be viewed. Maybe you want to keep some of those things, your own personal private balances, to yourself. But if someone wanted to go back and open up the set of transactions, there would be a transparent way to know how each of those transactions occurred, instead of it being some sort of black box with trying to avoid that and have openness in these systems that can be viewed by everyone and therefore can't be changed retroactively. I think there's a lot of current and future opportunities in decentralized finance, and we'll get into some of that here as it relates to the actuarial profession. Some of the things that are highlighted in this paper that we did are their applications are really focusing on decentralized exchanges. I mean, today, the antiquated version of something called, air quotes, an exchange is you physically had to go to a place with goods in your own basket and then find someone else who happened to also be going to the same physical place and be present so you could exchange. I mean, that's how a barter economy sort of evolved many hundreds of years ago. You had to bring your goods to market in order to buy or sell on the exchange. But the beauty of decentralized finance is this evolution of decentralized exchanges. So under this concept, users are there to exchange or swap or do transactions, with smart contracts being the glue that holds it all together, rather than having to have some custodial intermediary kind of play the exchange role. That happens in a lot of exchanges where you historically would have brought your goods to market, and maybe you didn't want to hang around the market, so you had them handed over to some custodian some intermediary who took possession of them, and then they would do the opportunity for buying and selling. But in a centralized exchange, the exchange kind of sources and supplies the liquidity to allow that trading to happen. But when exchanges become decentralized, it's more automatic. There's automatic market making, liquidity is provided by all these different liquidity providers. And so that can be one of the benefits if it's able to be done in a decentralized format. And because of that, this is where stable coins have certainly become more headline news or opportunities as well. They're kind of crypto tokens or cryptocurrency. Often their values might be pegged to a local domestic market currency. There's a variety of these stable coins that have evolved over time. I think we've seen through some recent transactions, stable coins, they may not always be as stable as we think they are. They're kind of based upon the user base and the transparency and maybe the volume that they have built up that builds their liquidity and how much they can be transacted. And there's certainly some of these designs, though, that have really lower levels of risk. Others maybe a little bit further down the risk spectrum, but decentralized finance certainly allows that to happen as well. And I think it's an encouraging thing to kind of see that things can be transacted a little bit more this way. And maybe in some cases not necessarily have a strict tie to a local market, a fiat currency. I think the next step is that you see some markets around the world, literally trying to convert and have digital forms of their national currency. So China has started taking that step. There's a question in the US market for sure. Should we have a digital dollar? What are the pros and cons of having that type of digital dollar stable coin available in the US market or for use even all around the world? Is it going to create more diversity? Is it going to create a situation where there's better socioeconomic diversity? These are the type of questions that many federal governments around the world are wrestling with right now. Should there be a form of local digital currency that can be exchangeable, interchangeable? You can do lending and borrowing. It's certainly an opportunity, and using decentralized finance, these types of platforms are quickly evolving. So think of this as a situation where instead of having to go to a bank and show that you have credit, you would have had to gone through an underwriting process on your credit, walk through that process. Instead, you may be able to go through smart contracts and digital transactions and do lending and borrowing services from an online community and enable peer-to-peer lending rather than from a strict financial institution. That seems to be a growing trend, peer-to-peer lending, where more and more you're hearing about taking out the intermediary in the middle, a banking and lending institution. And there are things that people can do. It's just growing that way. It's how historically it probably originated before the concept of central banks came around and the banking system came into play. And maybe the banking system has put some good protections, consumer protections around that. Maybe some lending practices that are appropriate to do that. But peer-to-peer lending and borrowing, much more enabled by these types of technologies. And the same thing with portfolio management. It's starting to evolve as well. There's just these different types of protocols and different strategies that overall could be complex and costly to implement because of transaction fees and time and effort. But if they're all integrated into a set of decisions or blockchain portfolio management strategies, decisions can be made, it can be transparent, it reduces the cost of transactions. Maybe transactions could be batched in order to implement. I think that's something just to keep up and pay attention to, is how either individual or corporate portfolio management may evolve through these technologies. I think there's a lot of insurance and applications here as well. I mean, we talked about peer-to-peer lending, an opportunity for smart contracts to also potentially involve this concept of how will traditional insurance products potentially be offered, and sometimes regulators supervised by supervisors, but is there a potential to have peer-to-peer insurance offerings at some point as well using smart contracts? I think there's other growing insurance applications that seem to be on the horizon. Innovative insurers, they're always thinking about how can I take this historical, traditional insurance model, the brick and mortar model perhaps, and then grow it using some of these decentralized finance or some of these blockchain sort of contracts, smart contract covers, where it might involve into different ways to do it. One example for sure would be parametric insurance models. That's a model where, if you take a step back, traditionally, to have an insurance payoff, there needs to be something that has value, something that is insured, and we probably actually need to see some sort of physical event or physical damage to the asset, whether it's a car or property or something like that, or to have an insurance benefit payment. But parametric insurance would look at this and say, well, what we're really more interested in is just looking not only at the individual physical damage, we just know that some events trigger those types of things to happen. And I don't need to see the specific type of loss that you might have. I just need to know that a parameter was hit. So for example, if we know that the wind got above 80 miles an hour, say as a threshold, or precipitation was above a certain amount for a certain rate of time, there's going to be this presumption that losses are going to follow. And it can just trigger an automatic claims processing where you don't even need to see a picture of what the damaged property was, your vehicle, your property, your home, anything, or a crop or something like that. You just need to know that this parametric trigger may have been happened. And the insurer may say, well, I know I'm probably maybe overpaying in some places, underpaying in some others, but it allows for a much more automatic claims processing, more immediate, more frictionless, and just different ways to offer insurance by leveraging off that technology. So I think that's a lot of things that are happening. I think there's, as well, a lot of consulting and new entrepreneurial opportunities. The decentralized finance ecosystem is certainly evolving. There's a lot of actuaries who've already jumped in it for sure and are a big part of it. But as we think about, more research that's needed, these are the things that we need to be thinking about. How can we take the traditional insurance and bring it up to speed with a new level of technology? I think actuaries really have an opportunity to apply their skills in data science and analytics to study and simulate the behavior of users and then turn them into new types of opportunities. So, more to come, but I think we're just starting to see what the evolution of it is here. I think I'm going to turn it into maybe some questions and feedback here. A couple of things I put on this screen for your benefit. If you're not following the SOA on social media, I certainly suggest you do that. It's a great way that our marketing communications area reaches out to our members through social media. Really helpful things on Facebook or Twitter or Instagram, different places, wherever that might be in your feed. It's really helpful. Clearly, we do that with research. Again, we do it with exams and professional development. So you'll see all the things that are going on in the SOA. And even, if you'd like to follow my accounts as well, I tend to use my personal Twitter and my LinkedIn to highlight things that are new things that are happening at the SOA Research Institute, or things I think the actual community might be interested in. And certainly not just limited to what's going on here in the US or North America. We certainly have a lot of things that are happening all around the world. So let's connect, especially on LinkedIn. I've included my LinkedIn information here. Just let me know you saw my presentation as part of the Society of Actuaries of Indonesia and this Research Institute presentation that you gave. Well, we can take a look at all that we've been doing here, and I think we have a couple questions that we had in line, with the first one centered a little bit around, I guess, what we were talking with some opportunities for actuaries and technology in the technology space. And I think what the question is here is how do we get how do we use that beyond what I'll call traditional actuarial work? And I really think the answer to this is a broad one. Just interacting with all the actuarial professionals the past couple of years is a small sample, but I think it's representative of what's happening. We're seeing actuaries use their talents and their knowledge, not only just the mathematics and the analytics and risk management, but also from the technology side, whether that's knowledge about how the computer systems work or predictive analytic tools that can be implemented. I just had the opportunity to present and attend a meeting at what's called the Association for Home Office Underwriters here in North America. And you would think that it's full of underwriting people, And to be honest, more and more that I'm seeing, there's a lot of actuaries who have taken on these types of key underwriting and analytics roles, especially really large management roles in the underwriting space, or maybe in the claims adjudication space. They're using their actuarial knowledge, especially of technology and their actuarial science knowledge, for a better and broader purpose, and going into different roles, from across the insurance, reinsurance, and consulting industries. And the same can be said for roles in information technology as well. I mean, just the managing this expert management panel that I was talking about, many of those people are clearly playing big time strategic leadership roles in their companies, in their information technology hierarchy. They're becoming chief information officers. They're becoming chief technology officers. They're the ones leading the strategy, not only because they know a lot about technology and how it can be used, but it's really beneficial for them to have what one might say is this operational knowledge of how their full financial services or insurance company works. So that as they're creating a strategy for the company's technology, they're also able to bring that with them and kind of speak the language of all the different operations going around the company. So more and more actuaries moving into those roles as well. I think, another question that we have here is along the lines of, what types of decentralized finance or DeFi, what do we see as some opportunities in the future of insurance? And I guess I'm taking this question to be a little bit more around, hey, we talked a little about peer-to-peer lending, but what's the potential analog or the potential concept in peer-to-peer insurance? And I think the answer there is it can come out in a couple of different fashions. I mean, just rewind for a second and take us back to what the actual origins of the concepts of insurance and pooled risk were. If you go way back, you talk about ship merchants wanting to insure their ships and cargo, and they walk into the Lloyd's of London and have this pool of different risks. But if you're to take that concept and then fast forward into modern time, there are obviously situations where people may have unique risks, or because of their unique risks, they may not be able to get insurance, or maybe it's just that there aren't providers of insurance for that type of risk in their area. So, how do they have enough diversification to cover risk? So how would this happen? And I'll use a North American context here as well, but it certainly applies to any market where agriculture is important. I mean, agriculture is sort of at the heart of the insurance world as well. It became a hazard for sure for farmers to grow crops and store them, or to store all their assets in one place they're using for their farming operations. So the concept of building a barn to store different farm machinery, or to store livestock, or to store all the feed that you would need for the operation of your farm. And if that barn caught on fire, it was really a devastating financial event for the operation. And before modern firefighting systems, that certainly became a problem. The distance between a fire station to a rural farmer could be large, or they just didn't exist. Many of these agricultural places in any market, any country, are just far from cities, and hadn't been in places where fire protection had been developed. And so what would they do? They would approach an insurance company and say, I need to insure this. The insurer would say, look, it's too big a risk. I would need to get 500 or 1,000 different barns to diversify my risk. There's no way we can get enough pooling here to do that. But what they did is instead kind of created a mutual relationship. All these farmers came together and created their own farm or mutual insurance companies. They said, I've got a barn, you've got a barn, everyone else here has a barn. Collectively, let's pull our risk together, form some sort of mutual relationship, and we'll set the premium, and get a sense of risk and diversify the risk. Well, that's really, in modern terms today, the opportunity, I think, for peer-to-peer insurance. That's how it can happen. Using blockchain technology and decentralized finance to do that, it becomes less frictionless. People all across, tons of different markets or different places, even all around the world, could come together into the same kind of theoretical room. The room might be virtual. It might be, on a Zoom call, but enabled to transact and create smart contracts and, be able to get covers for those types of situations and not have, a huge barrier to entry and be able to track and determine what the risks were. So that's really been enabled, I think, a little bit more for new opportunities in peer-to-peer insurance. Well, with that, it's going to be the end. I'll follow up by just saying, thanks everyone, including the organizers here, for the opportunity to present. It's been great to do this virtually. Looking forward to the day again where we can have this type of seminar in person and we can attend, through the Society of Actuaries of Indonesia and through the SOA, coming to a local place or someplace that's central to organizations and markets all around, the area there. Thanks for the opportunity to present and help kick off this digital transformation and artificial intelligence webinar today. Looking forward to connecting with you all through it. And with that, I will turn it back to the host to get us moving on for the rest of the seminar. Thanks, everyone.
Okay, thank you very much for your words, your presentation. So right now I'm going to introduce you to our next speakers, Nicolasio FSA, Debbie Oi, and Nadia Suharto. Nicolasio FSA is a Fellow of the Institute and Faculty of Actuaries UK and a Fellow of the Society of Actuaries US. He founded Nicholas Actuarial Solution in 2015. He is an actuary with exceptional business acumen and a global perspective. He has over 15 years experience in actuarial work, and he has developed various technology and software applications including IBNR robot, ReSEC, and PAA robot. And Debbie joined Nicholas Actuarial Solution in 2018. She has 3 years experience in the actuarial industry and has extensive experience in wide range of actuarial work. She has led several actuarial software development projects including PET robot, LRC robot, LIC robot, ReSEC, and InsurTech. And Nadia came from Indonesia and joined Nicholas Actuarial Solution in 2019. Nadia specialized in life and health insurance product design and pricing. She has over 2 years of experience in various product development, product pricing, and so on. And Nadia has led and participated in pricing projects for clients in Malaysia, Indonesia, Cambodia, and Myanmar for multinational and local insurers. To speak about developing actuarial application using R-Shiny, let's welcome Nicholas, Debbie, and Nadia.
Selamat siang semuanya. Seperti yang sudah dibicarakan tadi, nama saya Nadia. Saya salah satu actuarial analyst dari Nicholas Actuarial Solution. Bersama saya dan Nicholas sendiri dan juga Debbie. Mereka yang akan membawakan webinar hari ini. Pertama mau terima kasih bagi semuanya yang sudah hadir. Jadi webinarnya yang seperti sudah dikatakan tadi adalah mengenai developing actuarial applications using R-Shiny. Webinar hari ini akan dibawakan dalam bahasa Inggris, tapi ingin diucapkan dulu di awal bila misalnya nanti kalau kita tuh terbuka untuk pertanyaan baik dalam bahasa Indonesia maupun bahasa Inggris, karena saya sendiri dari Indonesia dan Nicholas dan Debbie cukup paham bahasa Indonesia, walaupun mungkin nanti dijawabnya bisa pakai bahasa Inggris. Tanpa menunda lebih lanjut, kita bisa mulai webinar hari ini. I'm passing the mic to you, Debbie.
Thank you, Nadia. I will first start with the first part of the presentation, which I will talk more about how R-Shiny works. And then after that, Nicholas will talk more about how this R-Shiny can be used in doing our actual work. And actually, earlier we have already presented this topic at the SOA Asia Pacific Annual Symposium. And we have also changed our content for this round by presenting what we think you want to know. Okay, let's get started. Okay, let's go to our first topic. So firstly, as an introduction, we need to understand why do we use R-Shiny. So R is the statistical programming language, and we generally can write it like how we usually write the mathematical equations. So it is suitable for the actuaries to perform the actual work because most of the actual formulas can be easily written using the R language. And also there are many R packages available for doing actual work like distribution analysis, mortality, curve fittings, and things like that. And also there are also many R packages available to perform machine learning works like regression, GLM, random forests, and so on. So R-Shiny is one of the R packages which can basically wrap up all the R functions and form into a whole R-Shiny application with a user interface, meaning that the user can interact with the R-Shiny by changing the inputs and it will show different output. So with these R-Shiny tools, the actuaries can perform their work faster and potentially more efficiently, especially if they have a large amount of data to process. Okay, this is just a sample performance test for an R-Shiny app with a different number of data being processed. So we can see how fast the work can be done given how much data is being processed. So in terms of the performance, R is also very useful and powerful in working with large amount of data, and it is easy to perform this data wrangling and also this ETL work using R. And in addition, the R can also connect to external SQL, non-SQL database, and also web services to read the data. So it is very flexible. Okay, now we can talk about how do we build the R-Shiny application. So we want to share with you what is the general thought process when we design an R-Shiny tool. So firstly, we would usually start with a simple Excel model. We will outline all the formulas and also what function we want to put in the R-Shiny tool. After that, we will illustrate the R-Shiny tool's user interface to plan how the R-Shiny tool should look like and where to put the inputs, where to put the buttons, and also how to output the tables, the graphs, and what features we want to include. So we will ask ourselves questions like, what is the objective of building this R-Shiny tool? Who is going to use the R-Shiny tool, and what do we expect to know from the output or the results of the R-Shiny tool, and so on. And then after we have an illustration of how this R-Shiny tool should look like, then we will proceed to write the codes. Normally, I would start by designing the user interface according to the illustration first. Then for the R functions, I always start with writing the base R codes first so that it is easier for checking and also debugging. Then if all the functions in the base R codes are showing the expected output, I will then put the codes in the server function of the R-Shiny codes. Then it basically wraps up into a whole R-Shiny application. So after we have this R-Shiny tool built, we will need to perform these user acceptance tests to make sure that everything works properly. And then lastly, we will work on documenting the tool and then the codes. Okay, I will now pass to Nicholas for the remaining slides.
Okay, thank you, Debbie. So Ibu Bapak, saya Nicholas, and I will continue the presentation in English. So I think one of the questions that I always get faced is that why do we build our tools using R-Shiny? Why do we not use other applications? So I think there are a few reasons for this. One of them, which Debbie mentioned earlier, is that R-Shiny basically has the capacity to handle big data in a linear way. So you can increase the number of rows without disproportionately increasing the number of speed. The other point that's important to note is that currently all the fresh graduates that we employ actually have learned how to use R in the university. So when we choose an application, a software application, we need to make sure that this is something that can easily be maintained, and the maintenance actually require that there is a large proportion of the workforce that actually is capable of maintaining the software. Then the next part also is that what happens about the future? How do we ensure that we have a platform, a software that actually can be continue to be relevant 5 years time, 10 years time, so that we actually don't lead to having a software that become obsolete and it cannot be used anymore. If you look at all the open source software, you can see that open source is actually a very fast growing area where there are actually many people, the user is increasing, and also support for users are also increasing. You can see in many online forums where there are various discussions, and also support that you can get from many different experts around the world. Basically, they will actually, if you post a question on how to do certain things, within few minutes to a few hours, you will actually get many response, and these response are actually of very high quality. So with this expansion of the open source community, right, we also need to make sure that our software is continue to be relevant. So this is why actually R-Shiny is a lot better than many traditional software that actually do not have this type of support. Debbie, can we move to the next slide? So let me give an example, right? So we have many R-Shiny functions. So for example, we have this risk heat software where we actually need to produce a heat map for risk management with the frequency and severity of all the different risk events. I mean, we can use R-Shiny because there's a way to plot all this in a graphical way, so that we actually can get the desired user interface and the user experience that we want. I mean, I won't go through the coding at the site, but you can see that that there's no problem in labeling, in basically populating a complex graph. Next slide, please. So then another example of the R-Shiny function that we actually have, which is actually very useful. I mean, we can show you, this is a LRC robot that we are doing for IFRS 17. So what happens here is that you can see that there is actually two tabs that we can put together side by side with actually a manual adjustment function. Many currently out of the box type of software, right? Basically, when you buy them in a box, they assume that everything works perfectly, and when something is not working as it is, you actually have to go back and retool and code again from scratch. I think this is what many IFRS 17 solutions are currently facing, this type of problem, where if the solution has a feature that does not fit the specification of the business, then basically we are stuck. When we use R-Shiny, right, we actually can put together a manual adjustment function easily, because we actually need to, we have the foresight that when we build the app, things are not perfect, but we need to make sure that for any subsequent adjustments required, right, the app need to be robust. So by having a manual adjustment type of function that can go into a automated type of solution, we actually have this benefit over solutions that can only be used, be calibrated by changing the coding and changing the structure. So another important thing, that R-Shiny is actually very dynamic and robust compared to a lot of other softwares. Next slide, please, Debbie. the other challenge that actually many life insurance companies currently have is actually we have this challenge with the aggregation of the per life aggregation to calculate the insurance reinsurance amount, right? Because we have these reinsurance treaties that we require this aggregation per life, and from here we need to be able to identify the same customer when this customer bought the same policy and things like that. So basically, if you can see on the screen, we have this customer ID, which actually represents that this customer has multiple policies. In the first example, actually, this first customer ID one has like has the same policy. So basically, one basic and 4 riders. But in the second one, actually, you can see that this customer ID 2 has 2 different policies and many different riders. So the challenge is actually to aggregate this together. I know many companies would use other data software. Some of them actually can handle this data, this type of aggregation quite quickly, but some of the more traditional software actually to run this type of aggregation would take a few days. When you use R, because of the data wrangling function, right? As in we are able to have many different ways. What the coding that I put at the site is one of them, where we can actually have use a cum sum function for those that are not duplicated policy number and customer ID, right? We actually able to sort out all these per life aggregation in a matter of seconds. So when we have this type of feature, when we use it to calculate our reinsurance accounts and the reinsurance administration, right? There's actually a significant speed and the execution advantage, right, over traditional software that does not do this, or I think some insurance company will also use the simpler method of avoiding this aggregation by actually having a different treaty structure with the reinsurer. But by doing this aggregation method, we are actually able to carefully quantify how much risk per life that we have taken. Yeah. Next slide. So in the next part, actually, I want to share with the audience some of the R Shiny tools that we have developed, and then also to explain to you what are the applications of them and why we actually do this work. So in our screen here, you can see that this is a LRC robot. LRC stands for liability for remaining coverage. The objective of this robot is actually to perform the IFRS 17 calculations for general insurance. So the setup of it is that on the left hand side, you can see a menu which actually can have all the different calculations sorted out in a different tab. And then you can see on the right hand side, basically it's the main results display. We can display this by PAA, which is the premium allocation approach, the simple approach for IFRS 17. And then the GMM, which is the general measurement model, which is the default model for IFRS 17. With this, what you can see here is that we have filtered this by PAA for the class of motor act, which is the motor class that contains also the bodily injury, third party bodily injury. We can have this by gross, net, or NRI. And then with this, we can also have all the different portfolio, different class, different subclass. So the benefit of actually using R Shiny is that we are able to handle the data, right, by many different types of granularity. We can drill down the presentation. We can aggregate the presentation in just with just a click of a button. And basically, it is what you can see here is the LRC account by different currency, and then can see all the accounting items that are available from the opening balance all the way down to the insurance revenue, service expense, finance income. I think we cannot show the whole. We didn't show the whole screen here. And the button that you can see right above the LRC account is actually a download button. the benefit also is that it allows us to generate many sub-reports, and when we click the download button, we actually download an Excel file that only has this specific measurement model, class, and currency. So this actually allows us to all the ability to use the reports here. Next slide, Debbie. And then you can see here we have a LIC robot. This is a liability for incurred claims. So basically, it deals with the triangles. And if you look at the top, we can see that for each class of business, we can have all the different triangle methods. The active tab is the incurred link ratio. We have paid link ratio, incurred BF method, and all the other different methods. And if you move towards that, we have also the claims handling expenses, and then how we use the MAC method to generate the risk adjustment, how we select and how we read the results. And from the triangles, what you can see in the main screen is that we are able to project the future claims according to accident years and development years for all the, I mean, the above part is actually the incurred claims, and the below part is actually for the paid claims. So once we put in the data into R Shiny, right, it's actually able to generate all the triangles that we need for reserving and all the different methods and the projections. So this is another good feature about R Shiny, is that it's actually very easy to build IBNR triangles from it. Next slide, Debbie. Okay, and then now I show you this React, which is what we use to do reinsurance accounts. You can see that we are able to produce this reinsurance statement, right? The accounts which has the premiums, less the commission, less the claims, less the taxes, and also the profit commission. Finally, come out with the results after the profit share. And also down there, we can produce a profit commission statement. And we can do this for all the insurers that we have. We can do this for the different insurer, different tranche of business. And if you look at the setting box at the top left-hand side, you can see that we can easily choose the display by selecting and deselecting certain tranches and different reinsurers that we want. And then from here, we can dynamically print out all the results that we are looking for. So basically, this works like a complicated Excel file that we would use to generate reinsurance accounts, but different from a traditional Excel file. This is actually how to say, it's not at the results are not editable for the user. The coding is in the background, and the user will only put in the data and then get the output. So it actually eliminates all the errors and such from the Excel.
Hello, Nicholas? Okay, it seems that there is an interruption in the connection. Mungkin Bu Nadia bisa dilanjutkan terlebih dahulu.
Debbie, do you want to continue the presentation?
Yeah, sure. So I think Nicholas dropped off the call. So sorry about that. I think he will be back in just a minute. I will just take over for this slide. So this slide is actually quite similar to what one of the previous slide that Nicholas showed just now, which is to produce this heat map, and it is pretty similar to what Nicholas has already explained in the previous few slides. So basically, the user will be able to just upload this risk register, which is in CSV format. This is just a basic database, and then with all the background R functions, after we upload it into this R Shiny application, and then the R will automatically generate all the results, and this heat map will be generated automatically in this R-Shiny. So in conclusion, as you can see that all of these examples of R-Shiny application actual work can be done in a very effective, and also because of the large amount of data, and everything can be run automatically and also much faster as well.
Hi, so sorry, I disconnected just now. I'm back. Debbie, please continue. Sorry about this.
Yeah, I think I can pass it back to you, Nicholas.
Okay, do we have another slide?
I think this is the last slide already.
So everyone, very sorry I disconnected. I think the connection is not working as I envisaged. I just want to add is that the objective of our presentation today, I think, is to share with everyone some of the tools and the software that we have built using R-Shiny in the last few years. So basically, we will use this for our work, and also our clients would also can also install this and use this either on cloud or on site. Actually, any Excel file that you have currently, you can always consider converting them into a R-Shiny application. You can see that it actually first gives you a lot more security, because in the Excel file there are really many errors, and over time the file becomes very hard to maintain, especially if the data is a lot. And at the same time, also when we move to an application, basically the side benefits is that there needs to be a set of coding that actually makes sense for many scenarios, not just the existing one. Whereas the Excel, when we use Excel, normally if we hit a roadblock, we just make some adjustment to the Excel. But over time, this is not so good. When you actually convert your work into an application, right? What is also needed at the same time is an established SOP, established documentation, and all these things together with the automation and the ability of the app in terms of processing power, and actually gives a lot of benefit to the work that we do, which in turn you will be able to experience the operational efficiency that actually currently would not be available with some of the softwares that I think either you buy instead of build, or if you are using Excel or some other traditional way. So I would actually encourage everyone to actually try to look into this type of development in terms of operational efficiency. And I think in such a working environment also it improves everyone's working situation, because saves a lot of time, reduce a lot of frustration. Yeah, so I think this is what I would like to do to close out my presentation, and I think we can take questions.
Ya, Bapak Ibu, jika ada pertanyaan silahkan boleh diketik di kolom chat, atau mungkin raise hand terlebih dahulu, kemudian menanyakan langsung kepada speakers. Okay, so please, if you have some question, you can write on the chat box, or if you would like to speak directly, you may raise your hand first, and we will allow to speak. Okay, while we are waiting for the question, so I have a question. What is the reason for building these R-Shiny tools? Okay, maybe you can answer.
Sure. So I think the reason for building these R-Shiny tools are there are quite a few different reasons. Some of them is because for example, like the React, we actually built this purely for a commercial reason, because we want to license and we want to sell this tool to our clients. because we realized that many of our clients have challenges with reinsurance accounting solutions, and the reinsurance accounts is normally lagging behind. There are many mistakes, and once in a while, actually, there will be disputes in the claim. So we actually built this. Software from scratch, based on our understanding of the market need and the market demand. So we license this to our clients, and we also provide a management service to our clients using this, because we also understand that under the current situation where the clients have some difficulty with the reinsurance accounting, right? Normally what happens is that the staff that's involved in doing the work also are not very happy, and there's actually a high turnover of this type of staff. So by providing a better infrastructure, we believe that this can also help to address the staff turnover issue, because less manual work, not so tedious. The staff does not have to work very hard and produce not good work. The staff can work less, and the work quality can improve. So this is why we developed this reinsurance accounting solution. We designed our IFRS 17 robots is because the LIC robot. The main reason is because we need to automate the calculations for our existing clients. We realized that we cannot actually do the same work under IFRS 17, but use the existing infrastructure, because this will actually give rise to a lot of challenge, because from our experience is that because this IFRS 17 is new, right? So every time when we produce a result, there will be aspects that is not yet addressed, or we need to make some changes. So this is why when we have our Shiny tool, right, all these things are already done in advance, and we don't have to do very, very much manual work over and over again. We make the risk heat, the risk register, risk heat map that we showed earlier, is because the main reason is that many companies do this type of work using Word or Excel or some kind of simple infrastructure, right? And very often is very, very manual to prepare all the different different risk register for different departments, different reports for different purposes. So there needs to be a way to efficiently produce all these reports. So because of this, we have produced this app. So I think there are many reasons why we built this. Ultimately, we believe that this actually brings significant operational efficiency.
Okay, so very detailed answer, Nicholas. Thank you. Okay, the second question, what is the difference between R and Python? So you can answer.
Okay, so I think R and Python, both of them can do similar things. I myself only know how to use R. I do not know how to use Python. In terms of, I can share with you in terms of my analysis of the market. So when we choose the software, it's important that we have the resources. Based on the profile of the candidates that actually come to work with us, we actually see that all of them can use R. Some of them can use Python. So this is basically the profile of the actuarial analyst that we can recruit. So for example, there are people like Debbie that can use both R and Python. Maybe I can ask her also to elaborate on this question.
Yeah, sure. So I think R is mostly used for statistical programming work. So it's better for working with data, and especially if you want to work with this data visualization, R is more suitable compared to Python. And for Python, we normally use it for machine learning work, because when we write Python, it actually writes it like imitating how a human would work on a computer. So normally Python would be used for automation work rather than working with data. Yep.
Okay, so thank you for the answers. And there is a participant send a direct message to me dari Ibu Yedi Sinto, Ibu atau Bapak Yedi Sinto ya. Okay, I'm going to read the question. Beside for IFRS 17, can these R-Shiny tools can be used for actuarial projection, experience study, or pricing tools?
So currently, basically our LIC robot is used to do projections. Because we project the triangles, and basically any Excel spreadsheet that you have actually can be converted into a R-Shiny tool. So I think the answer is yes, we can do this for all of the topics that was mentioned in the question.
Okay, so the answer is yes. Okay.
Yes.
All right. The next question is from Bapak atau Ibu Ari Agustiansa. Can R-Shiny integrate to core system that use other programming languages like Java and PHP?
Okay, so R-Shiny is capable of actually having this API as well as how say communicating with other servers, other systems in general. So I think the answer is yes, but significant work needs to be done to make this happen.
Okay. All right. Thank you. So is there any other question from the audience, please? Oke, Bapak Ibu jangan malu-malu ya. Atau mungkin mau langsung dalam bahasa Indonesia, silahkan. Di sini ada Bu Nadia juga yang bisa membantu kita. Oke. Okay, while we are waiting for the question, what are the limitation of R-Shiny?
I think currently, based on what we know for actuarial work, we don't encounter a lot of limitations. Of course, compared to Excel is a lot more flexible, and the skill level for Excel in general is still higher than R-Shiny. So there are still a lot of people that do not know how to use R-Shiny, or rather not an advanced user. So so there's still some execution challenge in terms of development.
Oh, okay.
And yeah.
Yeah. Okay. So yeah, there is another question. Okay. So this is from Bapak atau Ibu Leonardo. If you compare with Propet, which one is the best? My understanding is R-Shiny is just a framework. Am I correct?
Yes, R-Shiny is just a framework. So I mean, it can do what Prophet does if you actually put in the codings and all the functions that Prophet have. But by itself is just a programming framework, and that can enable various calculations to be done. It does not come with any built-in features like Prophet.
Oh, okay. And then for the next question from Bapak Purwanto, which one is more faster for iteration calculation between R and Python?
I actually do not have a software that uses both R and Python, so I think it's not easy for me to answer this question. But so far, I think based on my understanding, both R or Python also significantly faster than other traditional methods.
Oh, okay. Thank you for the answer, Nicholas. Okay. Is there any question from the audience? Because we still have plenty of time here. Oh, okay. There is a question again. So this is from Bapak or Ibu Ari Agustiansa. At our company, we use Julia language to calculate reserves. What do you think?
I'm not familiar with the Julia language. Maybe is it something that can be elaborated?
Oke, Bu Ari, mungkin bisa menjelaskan terlebih dahulu barangkali. Oke. Ya, halo, Bu Ari. Okay, so you are not familiar with Julia language, Nicholas, right? Oke, so Ibu Ari dari Nicholas mungkin bisa diinformasikan terlebih dahulu Julia language.
Maybe allow me to try. I think the efficiency of all the work is not mainly due to the programming language, but actually due to how it is set up. And if I understand correctly, Julia should be a newer type of programming language. So I think it should actually have all the modern features inside, and the language itself should not be a problem. Yeah.
All right then. So yeah, I hope that answers from Bu Ari questions. Okay, next, what should be the team size to implement R-Shiny?
Oh, I think the the implementation process would normally start with an existing calculation file, right? Be it an Excel file or some other programming language. So you need to have someone that understands how the calculation is actually working, and then from here you actually can start to specify like what are the improvements that you expect from moving to R-Shiny. And then we need to have a project plan, and then at least need to have one developer to actually perform all these coding. And then normally after development, we still have the testing part where we need to do. Depends whether it's a standalone application or something that needs to interface with other work. Then all the testing needs to be done, and then feedback all the defects to the developer before we actually can have a stable solution. So I think these are the resource that we need in terms of number of people. Ideally, the developer and the tester is a different person, so that we can have we can have some independence also in the work. Exactly how many people we need, I think depends really on what is the complexity of the program that we are trying to develop.
Okay, and continuing from the previous question, would this team structure in long run or just one off, and then we only need to maintain fewer staff as developer? Okay, Nicholas.
Debbie, can you take this question?
Yeah, sure. So normally after we finish building one R-Shiny application, one of the important things is that we need to have someone which understand how the coding works. So that we can maintain this R-Shiny application as long as possible, because actually for this R Shiny, one of the things that it's important to remember is that because this R Shiny is consists a lot of these R packages, and all these R packages may have updates from time to time. So if let's say you do not maintain this R Shiny application for quite some time, then when you go back into the application after a while without updating any of the things, you might not be able to run the R Shiny application. So I think it's pretty important to have someone to actually maintain the R Shiny application.
Okay, thank you for the answer, Debbie. And okay, this is from Bapak or Ibu Leonardo. Is R Shiny open source? Is there any community for this?
Yes, our Shiny is open source, and there are actually many communities available for this year.
Okay, Pak Ragil, would you like to speak directly to address your question? Okay,
Yes, thank you.
okay, please.
Yeah, thank you. I have several questions. Number one is whether our signing is a free license and no limitation data and period of time. Yeah. And number two is how simple to modify the formula. However, as we look the code that you show, it's like C script. Yeah, I think it's not simple to modify. And number three is can we create a new program or module in our signing? Example grace is like a cash flow calculation or something like that. Maybe three questions. Please, your answer. Thank you.
Okay, so
Yes,
you may.
thank you for your questions. So I think the first part is that in terms of the limitation of the R Shiny, I think the challenge is more on the hardware side. So if you are using a cloud service and it actually is have a high performance, basically we don't really have these challenges. The second part is in terms of how difficult is it to change. I think it is not. It requires programming and coding. It's not like Excel, but basically I would expect, or actually is the expectation, like for example in our company, that every single actual analyst can do this coding change. I wouldn't say that there would be a talent problem with this, especially with the new recruits. The last part I would like to say is that yeah, we can actually put in any formula that we want, and actually so there are some libraries that are there by default, and there are some that we have to code, but I think that's all these things can be done. Yeah.
Okay, Pak Ragil, I hope Nicholas have answered all your question. All right, so I think this is the last question from Bapak Muhammad Iqbal. Do you have a suggestion for our library to perform actuarial cash flow modeling? Example for GPV reservings, ALM, and capital planning.
So normally when we use our library, we use mainly for the data handling type of packages. For all these actuarial formula, normally we would code it ourselves. We don't normally use the standard libraries. Although I'm aware that there are more and more of these standard libraries available, but we prefer to code it, because I think the standard library may not be able to cater for some of the like practical functionality. So a lot of the standard libraries are still more on the academic side.
All right, so thank you for the answers, Nicholas. So I think that's it for the second session presentation. Once again, thank you, Nicholas, Debbie, and Nadia, uh, and stay healthy. Okay, see you next time in another event. Okay,
Thank you very much.
yeah.
Thank you.
Okay, so right now we would like to inform everyone that it is time for break. The next session will resume in about 20 or 25 minutes, and the virtual rooms will be standby, and we will see you at 10 past 3 p.m. Okay. Yeah. Hello everyone, welcome back to our next session. Now it is my pleasure to introduce you to our next speakers, Bob Charles FIA, Kaishong FSA, and Amos P. Bob Charles brings industry-leading actuarial and consulting expertise to Coherent's product suite and client engagement. His team supports the seamless integration of the products into client systems. Bob's career started as a fresh-faced actuarial trainee in Willis Towers Watson, leading engagement with some of the largest clients across many Asian markets. He left, he left as the head of the Asia Pacific region. Bob then embarked on the startup life at CXA Group, building the Hong Kong business of one of Asia's most prominent health tech companies. Kai Xiong is the actuarial director in Coherent. She is responsible for delivering Coherent solution and advisory services to insurance companies in Asia. With more than 15 years of industry experience, her areas of expertise include business development, product development, pricing, customer insights, appointed actuary services, and the likes. She is currently an EMBA candidate with the Nanyang Technological University in Singapore. Okay, for Amos P. Amos P is an actuarial analyst at Coherent Singapore. He supports the delivery of Coherent solution and develops solution modules to enable the speed, scale, and simplicity of Coherent's product suite. He works closely with the sales team to engineer use cases that addresses pain points of prospective clients. Amos is experienced in implementing Coherent solution in comprehensive insurance operation, including product configuration, reporting, and distribution. To speak about model tech, is your use of technology keeping up with your modeling needs? Let's welcome Bob, Kay, and Amos. Okay.
Thank you, Joseph. Amos, can you change the display setting to show the presentation? Yep, I think that works. Good afternoon, everyone. As Joseph mentioned, today Bob, myself, and Amos will be speaking on model tech. Is your use of technology keeping up with your modeling needs? At the request of PAI and SOA, I will try to speak a bit of Bahasa, but if you are unclear about the concept that I'm trying to explain in Bahasa, please type in your questions in the chat box. Okay, selamat siang Pak dan Ibu. Hari ini Bob, saya dan Amos akan present ini apakah teknologi yang sesuai dengan kebutuhan pemodelan Anda. So modeling is fundamental to how actuaries deliver value. So as we address the regulatory changes like RBC and RBC1 or RBC2, IFRS 17, or developing new products, we actually have to upgrade ourselves, improve our modeling skills. And with that, whether our technology keeps up with it is a question. All the actuaries here, we all have coded in Excel and some of the actuarial software and data analytic tools. So today we will share with you some of the knowledge that we have, and hopefully you can also learn something from here. So Modeling adalah like penting kepada semua orang sini. Saat kami ada peraturan baru seperti RBC, IFRS 17, produk baru seperti pelindungan penyakit kritis, actually mesti membangun model di Excel atau the software actual untuk memahami itu dampaknya. So without further ado, Amos, can you move on to the next slide? So this is a screen showing the microservices in insurance, which translated that briefly into bahasa layanan mikro dalam asuransi. As you can see from the left to the right, a lot of people or even applications are involved in insurance. So from the left, there are users like agents, brokers, insurance partners, and all of them. They use the front-end app, but the front-end app is not alone. It's not standalone. It's connected to the back-end services, for example, user management. So we need to be able to give the right to admin user or even just normal user who can just read or use the app, or someone who can actually change the app. So all these are backend services. Then of course, services, all these need to be connected also with the external systems or external platform. So think of it from insurance purchase. A customer comes in, look at the front-end app, play around with the front-end app, buy insurance that's connected to the backend service to issue the policy. In order to buy that, the customer has to make payment with the external platform. So that need to have payment gateway and external system, even connected to data lake to retrieve or store the information from the customer. So all these, if we cascade down to the purple color boxes, you'll see that that would be like data services from the left to the logging of the users, data storage where the data is stored, so on and so forth, including image. Because like say, think from policy illustration, that could be a PDF, and all these, how are those being processed or being stored? In bahasa, I'll make it very simple. Itu dari kiri ke kiri adalah itu service data, ada itu persimpanan data, dan ke itu image processing. Semua ini like bukan adalah itu microservice, mesti connect dengan satu, itulah API. So Amos, if you can move on to the next slide, that we can actually talk a bit more about how using microservices and insurance, how we use that concept and put it into models, and how that can be connected using API calls. Similarly to how we showed in the microservices and insurance, for the microservices and models is also from the left to the right, from using the data and then take the data and then put it into the calculation layer. And once that's been calculated, then it needs to be shown to the people who want to use the result. If we think about, say, actual valuation, the data needs to be taken from the policy admin system so that we can calculate reserve for these pool of policyholders. And that calculation layer can happen, say, in some of the systems like Profit from FIS or Axis, or even like Coherent Spark, or some of the other software provided by the providers. So once that has been calculated, that can be passed on to the reporting layer. So reporting layer, you can see here that either they use Excel to retrieve the results, for example, for Profit, or you use R-Shiny to take the results, or even Tableau to have the dashboard. So all of this, if we think about it like microservices, they are not standalone. They are actually interconnected using API. Later, I'll talk a little bit more about API. And then maybe just to share a bit more about this process, we also see that actuaries have been involved in the automation of this process, from data layer to the calculation layer to reporting layer. Some actuaries have been using some of the automation tools that are shown here, like Autrix or UiPath, and they actually have to pick up programming language in order to code in those systems. So nevertheless, it's not that difficult. So let us jump into the next slide on API and what it stands for to connect all these different layers. So essentially, for microservices to work, they need to be able to talk to each other. And to talk to each other, they use something called API. API stands for Application Programming Interface. So if we try to use this example from a restaurant, the kitchen will cook something that the customer has ordered. But the kitchen wouldn't actually just send the food directly to the customer at a specific table. They will need someone to bring the food to the customer, and the someone will be the waiter, like here. So like in bahasa, like dapur itu masak itu makanan, dan mesti kasih itu waiter, kasih itu makanan ke itu pelanggan. So using that analogy, you can see that waiter is very important in the restaurant, just like API is very important in the modeling world. And I think to the left, I think we have some write-up on calculation layer. So calculation layer will require the input, like if we think of it from data to calculation to reporting. Calculation layer, the input would be from the data, and then the output would be to calculate whatever it wants to calculate, for example, reserve for valuation, and then pass it on to the reporting layer. And how they can be connected is to really understand API, the inputs that is connected, that can be passed on to calculation. Calculation layer produce the output for the downstream, which is reporting layer, for this whole process to complete. Yeah. So if we go on to the next slide. Yeah. So actually, we don't have a very easy job. Rather, it's very challenging in the sense that similarly to the insurance industry has evolved, the tech industry has evolved, we have also evolved. Traditionally, we have a computer, the computer system. Everybody uses the same system. After many years, after a decade, we look at it and realize that because it's a whole system, we won't be able to change. You can't just take one part out of it and change it. Now, if we reimagine this whole thing in a microservices way, each of this can be actually broken down into smaller parts like microservices. So you can actually pick and choose the best tools for each part of the modeling process. So think about data layer, the calculation layer, so perhitungan, and then reporting layer, which is pelaporan. So each of these, you can choose the best tool for your own needs. You don't have to stick with one giant system. Rather, think about it from data layer, which of these is the best for your own use. Calculation layer, whether or not this is the fastest, and of course, without compromising the accuracy and governance for calculation, and then how that can be passed on to the reporting, whether or not Tableau or Shiny is best for your use. And all of these can be connected using API, that is the application programming interface. Yeah, in bahasa, sekarang bukan satu besar itu sistem. Ini boleh broken down into components, macam layanan mikro, and then kamu boleh to select, pick and choose the best tools. Moving on to the next slide. Amos will be showing how calculation can be done using spreadsheet as microservice. And all of the actuaries here, I believe all of you are very proficient in spreadsheet. So you don't have to be afraid if you were to change any of your component of your model, because you know how to use a spreadsheet and you can use some of the cutting edge technology like Coherent Spark in order to pick and choose the tools that you like for your modeling needs. Amos.
All right, thanks, Kay. So as Kay has mentioned, so far we've talked about the creation of an API and how an API can really speed up and create just create a sort of efficiency in the workflow that we're currently facing, right? So what I'm going to do is I'm just going to run through this slide very quickly, and right after that I'll just bring the screen to a demo portion where I will show how we make use of Coherent Spark to turn a spreadsheet into an API and then further deploy that onto an R engine, which then allows us to generate these valuation numbers that we need for the purpose of reporting, right? So at least in this place, we are looking at the calculation layer, which is performed by Excel, right? So because as actuaries, a lot of work that we do involves modeling, and we primarily use Excel to perform these functions. So what happens then is that in these spreadsheets, that's where we put all our logics in and everything. But sometimes when we want to publish that somewhere, like let's say, for example, we want to put the spreadsheet live for someone to purchase a product or something like that, it's often difficult because the developers need to understand that model. So what Coherent Spark does then is to convert these spreadsheets into a readable API, which then can be deployed very simply. The developer's job goes from trying to understand the model and recoding it, becomes the job of just receiving the API, looking at what are the inputs required and the outputs required, and just really building a UI based on those requirements. So there's no need for that knowledge bridge in that sense where the developer needs to go figure out what exactly this Excel is doing. Right, so at this point, I want to switch over my screen to just an Excel sheet, just to quickly run through a very simple demo for this seminar that we have prepared. Right, so let me just escape this first. Right, I'm just going to bring up the spreadsheet that we have. Right, so over here, we have an Excel sheet that is really just the typical kind of valuation file that you will see, right? You have an introduction to the file, a README, which just tracks the progress of the Excel file, which I will cover on a little bit later when I'm talking about Coherent Spark. That also talks about this use of a README layer, right? And then over here, the current screen that we're on is really the policy tab. So at this point, you see the usual culprits here. You have your age, your age evaluation, the policyholder's birth date, sex, so on and so forth. And then over on the right, you have the numbers that for this purpose, we are trying to generate for the purpose of reporting, right? So for example, if I change, like, let's say age evaluation to say 22, you'll see that the reserve evaluation date and the capital requirements change, right? So for this spreadsheet, what we have is that aside from this policy tab, you also have the usual things like sort of the assumptions that you're following, your mortality tables, and so on and so forth. And everything in the yellow here is used for calculations, right? So what happens is that we know the story, we put in a bunch of inputs, and then what this input does is that it then creates a bunch of cash flows to finally create a PV at the PV of the net cash flows, right? So over here, we have set up just like that, where as we take the first year of inception of policy, the in-force year, we just continue to decrement from that period on, and for as long as the policy is in force, we just create cash flows that are relevant to this policy. So we know the story that of how valuation is typically done, right? So over here, I'll move on to the next tab, which is, as you can see, RBC Labs Up. So the reason it's so is because we've created this spreadsheet to model after the RBC requirements in Singapore. So there's a requirement to shock the data with a labs up and a labs down. So it's also a similar setup in where you just apply an assumption. You apply a factor of labs that is within the assumptions table, as you can see here. So BE is at 100%, whereas everything else for labs up is up by 10, labs down is negative 10% for the labs factor, so on and so forth, right? So the story continues where you then continue to calculate the cash flows for the labs up scenario and the labs down scenario. And then you add in the capital layer as well, which is just another requirement of the RBC2. And finally, what you arrive at is over here in the policy tab, which is the maximum of these two values, which would then be used for reporting, right? So yeah, in general, it's what we see every day as reporting actuaries, right? So now the question is, with an Excel sheet like that, how do we then create a scenario which then allows this to be more efficiently done in the form of microservice, right? So what we have done with Coherent Spark is that in order to convert this Excel sheet into a readable API, certain things must be mapped, right? Because how else then would you be able to convert an Excel sheet into a bunch of code so easily, right? But what we do is that here with Spark, you don't have to do anything that forces a spreadsheet into a template, because all you need to do is to make use of this Excel feature known as name ranges. So as you can see here, I'm not sure how many of us have already captured this by now, but the cell that I'm currently on, I8, it's named as X output underscore reserve. So as you can see, the prefix of X output relates to the fact that, this file this particular cell on the sheet policy, cell I8, this is an output cell, right? This is a result that I want to see from this calculator, so as to say, right? And because of the fact that we see an output, there must necessarily be an input. And as some of you might have guessed by now, that is exactly everything on the left here, right? So just for a quick example, we have here enforced duration in months, and over here it's named as x input underscore for underscore enforced duration, or INFDUR, right? Because what we are doing here is that we're setting up a spreadsheet to be converted to an API, and for that to happen in Spark, all you have to do is use the name ranges and just name your cells a certain way so that it can convert all these logic. Because what we have in Spark is that the moment this is done, the moment you upload your spreadsheet, what happens is that all the complex calculations that you've built in here, the sequential calculation of cash flows to finally arrive at your valuation number, that calculation logic will be converted in the engine that we have created, right? So it's really that simple now to just use this as a microservice and finally creating that API to be imbued and integrated with whatever other process that people are using these days, right? So now at this point, we know that the Excel file needs to be mapped and we see that it is ready. I'm going to bring us to Coherent Spark where we see how exactly that is done. So over here, we have Coherent Spark, which is a bunch of folders, as you can see. So within these folders, just to clear up some jargon, within these folders will be individual services. So each of these services relate to one Excel file, which is also one API. Let me just run through a demo just to show how that will start to make sense, right? So let me just create a new folder here, and I'm just going in this valuation with R. Category, I'm going to put just other for this purpose because this is a demo, right? I'm just going to put here demo using term valuation. But really all this at this point is just for organizational purposes. So let me just go ahead and create that and just bring us through the rest of the journey and how this is done. So once a folder is created, as you can see in the background, a folder automatically appears, and because it's a new folder, it prompts you to upload the service. So in this case, what I'm going to do is that I'm going to drag in the Excel file that we've been talking about. So give me just a quick moment to look for that. There we go. So this Excel file, I'm just going to drag it here. I'm going to drop it, and immediately Spark recognizes the Excel file. It uploads the file, which in this case, it's a 3 megabyte file. And once it's uploaded, it starts looking for all those little X inputs and X outputs that we're talking about, right? It looks for those, it finds the logic path, and then it starts converting all those logical calculations that you have created in your Excel file and puts it onto its API. So within those few seconds, you see that 3 megabytes of calculation logic has been converted just like that. And that is the power of microservices today, because we would know that valuation in general is otherwise a very laborious task. So, and sometimes Excel files, when they are too big of a file, it can take a while to upload. But in this case, converting into an API really just takes that matter of seconds, right? So just to add on as a point, so this means that as long as it's mapped correctly, Spark will be able to read. And that also essentially means that whatever you can create with Excel, you can also be able to put that into an API and deploy it anywhere as you deem fit. Right, I'm just going to continue with the journey. Next effective time. So at least for this, I just want to quickly go through that, because an API can relate to a certain point, right? So what happens is that the moment you create an API out of the file, it just becomes effective. And as we're talking about microservices, at least for Coherent Spark, the thing about versioning is that if let's say you have a change in assumptions for this file that you're looking at, all you have to do is change the assumptions within that Excel file, re-upload it again, and Spark will recognize it as a similar file that has already been uploaded, and it will recognize that there is a change. And what happens is that it will then re-upload that file with all the new assumptions, and that API itself doesn't change, right? So what happens is that almost instantaneously, you can upload your new assumptions onto all these front-end UIs that are harnessing the power of your API. So updating real time just got a lot more real time, if you understand what I mean. Right. So let me just continue with the rest of the journey. And once I complete that, you'll see that Spark brings me into that folder that I've just created, right? So as we go in, we now revisit our old thing that we have talked about earlier on, which was the README tab, right? And what happens is that README tab's purpose was really just to track progress and whoever is controlling that file, right? So you have V0, V1.0, 1.1, 1.2, 1.2.1, so on and so forth. All that now is captured in Spark with this audit trail on the right here. So as you can see, whatever has been happening in this folder is now being tracked by Spark. So the power of microservices really just encapsulates more than just the creation of API. It also harnesses itself in the form of more efficient working and really just accounting for all these other little human errors that sometimes we face on a day-to-day basis, right? And that file that we've just uploaded is right here below in the Spark demo term valuation file, the one that we've just been going through, right? So all the magic happens right here in the API tester, where as you can see, when I open it up, there is an API endpoint immediately. So this endpoint will be used by any front end tool to harness the calculation logics that I used in this file. So as you can see, all the inputs that we have over here, age, sex, smoker stat, so on and so forth, and also the capital requirement and reserve that we have are all now met correctly. So at this point, what I'm going to do is I'm just going to quickly show, I'm just going to quickly run through a process that we've created, right? So what happens is that now you have put in the calculation logic, right? And that's the calculation layer. But in order to complete that whole workflow, you need the data layer and also reporting layer, right? You need the numbers to report. So what we have as a module in Coherent Spark is the testing center, which generally just allows you to UAT and mass unit test this engine that you've just created. So what we're talking about really is the creation of test bits, right? And really just loading up like a column full of like a single sheet full of all these inputs that we already have, right? And you just load it into the engine and you just mass unit test that engine that you have created, right? So that will serve as a workflow like what you have as enforce policy. You put it in, you run your API to generate those valuation numbers that you need, and there it just completes your reporting process just like that. So the testing center is right here, but rather than talk through the testing center itself, I want to bring us into the next layer of microservices, which is using R Shiny, right? So over here, as you can see, I have the code prepared. What I'm going to do is I'm just going to run the app. And we have it here on the right. Okay, so I'm just going to leave this here. All right, so as you can see, the moment the app is created, there is some authorization that you would require, that you would otherwise require to be able to call an API, right? So in Coherent Spark, under my profile here, I have a bearer token pin, which I'm just going to copy and put it in here, right? Once that's done, I'm just going to connect to Spark. And what I'm going to do is I'm going to upload a file, which would then mass create those results that I need for valuation. So let me just open up that file and drop in this Excel sheet called batch run, right? And when I put it in, then you see what that Excel sheet is, right? So over here, we have two model point files. One is we have two sets of 1,000 results, and all this will then be used to test that calculator that we've uploaded into Spark. So just as an illustration, let me just open up one of these files just to show how it looks like. Right, so we have over here 1,000 test cases. As you can see, it's MP_F. So it's really 1,000 model points that are female, right? So this might look familiar to some of us at this point because this really is meant to replicate how enforced policies would look like, right? So this is a test bit that we're uploading into the engine. Now what I'm going to do is I'm just going to go back into R, and I'm just going to click calculate. So let me just open this up, right? And I'm going to click run. And what happens is that immediately the process begins, right? Where you start uploading the files, you start running the model points, so on and so forth, right? Because this process is going to take a while because, as you know, sometimes in the past when you run apps such as Profit, you have to turn on your computers overnight for the engine to churn, right? So although Query and Spark has sped up this process by about like 100 times faster, I kind of need to do it right now in a span of 1,000 times faster because we're in a seminar. So let me just open up a set of results just to really show how that's supposed to look like, right? So let me just open this up. Okay, so as you can see, once that run is created, once that run is completed, sorry, these two tabs are what you expect to see, right? So based on the model points that you've uploaded, you know what, maybe let me just open up the female one so that we can do a quick comparison. So we see here, the model points that are created here on the left in the test, in the test bit has now been run and has been created on the right. So this is that little magic dust that you need for the completion of the valuation process, right? So this really goes to show how in today's economy, at least for us actuaries, we don't really have to stick with the very long processes of valuation anymore. There are solutions out there that can really enable us to speed up these processes, and even if not speed up, it allows us the bandwidth to use our computers while all these reports are running. Because if we're familiar with some Excel macro creations, sometimes when you run a macro, you can't really use Excel aside from that. But at least there are solutions out there, such as Query and Spark, that allow you to bring these calculations to the cloud. And so as you're running these calculations, your computer can still be used for other things, right? So that really is the introduction of microservices in today's situation. Right, so at this point, let me just quickly go back to our slides just to continue where we left off. Yeah, and I'll use this really as like a summary to what I've shared earlier on. So in the calculation layer for spreadsheets as a microservice, you have seen how a spreadsheet can be quickly converted into an API that is then ready to be deployed anywhere on any page as required. Then you have also seen the R code as a microservice, because what we have shown is that we have used R as a quick means to call an API from Spark, right? So the thing is that I want to go through the thing that really is important at this point, perhaps is best encapsulated in this second paragraph, which is that what I've written here is that R is able to call multiple APIs at once, right? So what this means is that you could have a layer for data cleaning, or sorry, rather a Spark service for data cleaning, and for one API just to clean your data, and then one API to calculate the data, and then finally another API to project and visualize these data. So you can have 3 different Excel services, all created through conversion into Spark to create an API, and all this can be integrated into a single process, which we have done through which we have did through R today, which in our case is just 2 steps, because what we've done is that we've put in the test data, and then there is a second step, which is to aggregate and sum up all these data, which I have not shown today, right? But the point is that with all these tricks moving forward, it can really create a lot of efficiency in the workflows that we have otherwise become very accustomed and used to, right? So as I've written here, as you can see, we can also use R for pricing, right? So for example, you want to quickly publish a travel product, right? So all you have to do is plug in that Excel into an API, deploy that on a UI, and it's ready to go. So that really talks about that really does touch up on what I've spoken about earlier on, about how now the developers really don't have to try to understand the model, rather they can really focus on designing the web page to enable the best sales of the product that we have created, right? So yep, as I continue, yep, what we have done is that we have used Shiny to show an example of a valuation workstream, right? And what we have also done is that, at least for Korean Spark, we've created an R package within that. So even if we're not very familiar with HTML coding for all these API purposes, we can simply use the package. And today we know that with R, data manipulation and data cleaning, data projection, in fact, has become so much easier with all these new toys that have been created, right, through Python, through R, so on and so forth. Then we went on to create then I went on to this, just to quickly show how the Actuarial Modeling Center, which is the R platform I've used, is really created, right? We have the code, we ran the code, and then after that, we put it, and then after that, we created this this results page, which would have been looking like the one in the middle. This one is just an add-on, because what you can do, as mentioned, for visualization purposes, is that once you've created all these numbers through the use of an API being called, you can then immediately project these numbers into a tabular format or even a graphical format, right? So that really does also quickly tap on the power of integration and API services, which then really brings us back to the whole idea of microservices as a way to move forward, right? And lastly, there are also tools out there which Kay has mentioned earlier on that can really allow you to create a work stream just like that. So what you can do is that you just simply press, for example, play, and then that work stream that I've showed earlier on can be done just like that. So a file is uploaded, a data file is uploaded, an Excel is created and converted into Spark. The data goes into a calculation, so on and so forth. You know the drill, you've seen it. All that can be done simply with a click of a mouse, and that is really that just really is a nice way to just sum up what microservices can do for us today. So at this point, I do want to pass the time to Bob, just quickly run through a case study that we have.
Yeah, no, great. Thanks, thanks, Amos. So I just wanted to maybe just highlight a couple of examples from that we've done in the Indonesia market with our partner firm in Indonesia, KK Actuarial. And so in the case of these are a couple of cases where the KK Actuaria had pretty large quantities of data that had to be pushed through a model. And for various reasons, the model was in Excel, so that they weren't using an actuarial system. They had to use a spreadsheet-based model in order to do the calculations. And I think that's quite common, even for companies that say buy sort of actuarial systems. There's still a lot of spreadsheet-based calculations that happen in insurance companies, regardless of whether you're using an actuarial system or not. But the challenge and with using a spreadsheet for doing these sort of long-term cash flow projections is that simply there's a lot of processing to do. And so in the case of the first case here, running through 260,000 policies, the second one, 1 million policies, it simply takes a very, very long time to do the run in Excel. And therefore, sometimes it's hard to really sort of use the model to its full extent. For example, doing scenario testing, for example, your flexibility to make some changes and then rerun the model. You're not going to want to do that very often if it takes you 1 hour and 40 minutes in order to do every run. And so by using this sort of concept of microservices, putting the Excel model into Spark along the lines that Amos has just demoed now, that enabled KK Actuaria, G'day and Michael and their teams in order to run these models much quicker, and also to have a lot more control over the different versions of the model as they change the model. And so I think we saw this as a really interesting example of how microservices can be applied in practice in Indonesia. And really how specifically how Excel can really be used as a as a very core actuarial tool, but used in a way that's much faster, that's much more controlled, and enables you to connect it, whether it's to a data source or connect it to a front end, as the R front end that Amos has just shown. Then it's really a very powerful actuarial tool, I think, and this is why we're really encouraging actuaries to experiment with these kind of new technologies. So I don't know if you want. Why don't you do this last one, Kay, in Bahasa?
I'll say it in English first. Yeah, so it's a great time to be an actuary. So my colleagues Bob, Amos, they have shown to you like how technology can be an enabler for actuary to perform all the sort of new tasks, whether or not it's new regulation, new products that you're trying to model. Understanding how new technology like microservices, how the API can be the connector from the data layer to the calculation layer to the reporting layer, that will be useful. So it's really a great time to be an actuary to be equipped with the skills and using some of the new technology for the task. In Bahasa, that will mean actuaries layanan mikro, like sekarang itu bagus, yeah, actuary.
It's a great time to be an actuary. It's easy to. Let's finish the presentation there. It's a great time to be an actuary. I think everybody can agree on that on this call. Yeah. Okay. No, thank you very much. I see we've got one question in the chat. So maybe if I make a start with that one, and then we can, and then obviously we're very keen to take other questions from anybody else on the call. So great question actually from Ari. I don't know if maybe you can just go back in the slides to the slide with the different layers, the 3 layers, just so we can see that one, because I think that's kind of goes to this. So I think it's Ari's question, I think, is making the point that which is absolutely true, that the data in the insurance world is normally a challenge for several reasons. Firstly, because there's a lot of it, because you've got a lot of customers, etc. But also often that it comes from different sources, that you have different databases. Sometimes you even have different, say, policy admin systems, etc. And so, and I think as we're starting to see with, say, IFRS 17 presentation, this IFRS 17 implementation, the data, organizing data, making sure you can access data at a micro level is really quite challenging. But I think your point here maybe answer in a couple of ways. So we don't necessarily mean that for microservices that the database itself has to be a microservice. So if you've got a policy admin system, everything works great, then there's no reason at all why you need to change that. It just simply means that if you've got different calculation tools, different reporting tools, you can sit them on top of the database, access the database, and then run calculations off the database as you need. So the microservices would be the calculation layer, the data layer would be a fixed layer exactly as now. Equally, I think we see a trend towards what I might describe as data lakes, where you have different sources of data in a company, and you kind of provide a virtual lake where that data is accessible as if it were a single entity, even though in fact you've still got many different sources of data, but you kind of organize them in a way that you can access them as if it's a single database. And so again, we've had a number of instances where we see Coherent Spark, other microservice tools being effectively being fed data from a data lake, and that's a very common situation in insurance, as I think you imply in your question, Ari. But also, I just maybe add that even on the data side, I think we are starting to see, it's early days, but we are starting to see insurers use some more kind of modern tools around data management themselves, I suppose probably the most famous one that we're familiar with is a company called Snowflake, which is essentially a data management tool, which is pretty powerful in terms of being able to access, to organize data from different formats, but then access it as if it was a single entity. But there's other tools as well, and so yeah, I think your question is entirely right, but just because you have just because you have data and insurance in constraints around that, I think that doesn't mean that you can't then use that data to feed microservices in the calculation layer and the reporting layer.
Okay, so thank you Bob for explaining the answer, and okay, thank you Kay for trying to present it in Bahasa. We really appreciate that. Okay, okay. While we are waiting for another question, I have a question. How much time can we save as compared to traditional processes?
So let me, I don't know, please step in, Kay, Amos. I mean, let me just give an example where we've seen recently here. So I had a situation where a customer had, an insurer was trying to automate a process, and so in this case it was involving a valuation process, fairly similar, I think, actually to the example that Amos showed, and so they put in place various technologies in order to move end to end for accessing the data, the policy records, wanting to put them through the calculation process, various validation and reporting checks as part of the process. But in order to actually do the calculation, they initially decided that they wanted to program into their automation tool using Python, essentially replace all the complex actuarial logic that was sitting in the model, program that up in Python, have to test it all, so that they could then connect that Python code into the automation workflow that they were building. And so I think we saw in this case that the kind of tool that Amos has just shown here, the Spark tool, enabled us to basically take the logic that was already there in Excel, complex actuarial logic, put it into Spark, and then through the API connectivity that Kay's described, just hook that into the automation process. So in that case, it actually saved several months of programming and testing time, because they didn't have to do the Python programming, that they could simply take existing Excel code, existing Excel spreadsheets, and create a microservice through Spark, so that they were able to connect it to the automation process.
Okay, so thank you for the answer once again. And as we can see in the chat box, there is a question from Ibu Hilda Pasaribu. Having the automation from data layer to reporting layer, is it the same expectation on the experience study automation?
Yep. So for microservices to work, the key is to really understand the inputs and outputs. So on this screen is data layer, calculation layer, and reporting layer. For experience study, typically we're looking at like how the lab experience would be. So then we need to know which are the inputs that actually drive the output. And what we want to know maybe labs by policy year. So certainly all this needs to fit into the data layer, then goes into calculation layer, say in QuickHear and Spark, and then produce the output, which is the lab study by policy year. So I would say that the same logic applies in terms of microservices, and all these are connected using the API.
All right, great, thanks. And I think this is the last question from Bapak Leonardo. It's a new challenge for life insurance company to think about microservices architecture, get rid of the old-fashioned monolith. Now, it's doable to build ERP application in insurance, especially can be combined with complexity and in actuarial figures. Okay, I think it's common, right? Okay.
Yeah, I mean, I think maybe just one thing I'd comment on this question actually is that I think one of the things that I like about microservices, or the concept of microservices, is that it's something you can do gradually. So it doesn't mean you have to throw away your monolithic system. In fact, you're not going to throw away your monolithic system. But very typically, for example, most large insurers have already got well-established policy administration systems. It's very hard to change those. And so it doesn't mean you have to throw away your monolithic system. It just means that you can kind of build on top of it. And what we tend to see, just take the example of policy administration, for example, is that you can then externalize functionality over time, gradually, that used to be in the policy admin system, and then you externalize it to an application that's connected to the policy admin system, but not part of the policy admin system. And so you can kind of build like that over time. So I think this kind of gradual approach is important, because again, it reduces your risk, and it just makes it more practical, more realistic in order to evolve your technology over time. In terms of ERP, I mean, I think ERP used to have quite a bad brand, because there were some very big ERP systems that were very expensive and didn't always work that well in practice. But I do take your point, and I think that maybe trying to build from building blocks to create that kind of approach could be the future. But I think your point about doing it in conjunction with actuaries is important. And I think back to the kind of great time to be an actuary, I think the more that actuaries can really work with technology teams to make sure that the needs of actuaries are reflected, and the view and the kind of the understanding that actuaries have of insurance is brought into the technology planning in insurance companies, that this is a challenge for all of us, I think, and I think one that's quite exciting.
Okay, Bob, thank you for the answer. And I think that concludes our third session. Once again, thank you so much for Bob, Amos, and also Kay for having a nice presentation. And all the best for you all, and stay healthy anywhere you are. Okay, thank you.
Terima kasih.
Yeah, terima kasih, Kay. Okay, so let's moving on to the next session. Now it is my pleasure to introduce to you our next presenter to speak about next-gen AI-driven digital risk assessment. He is a senior data scientist at Munich Re, working in the digital solution team in Singapore. He has over 7 years experience in the life and health insurance industry. His main areas of expertise are artificial intelligence and machine learning, MLOps, data engineering, auto underwriting, technology, automation, data visualization, and NLP. To speak about next-gen AI-driven digital risk assessment, let's welcome Ryan Gogan.
Hi, it's a pleasure to be here. I'd like to thank you for inviting me along. I just want to check you can hear me okay, because I was having some issues with my audio on the last call.
Well, I can hear you clearly.
Perfect. Great. Okay, so I'll kick off. That was a nice introduction. Thank you very much. I think the goal of this discussion is to step you through how Munich Re I suppose has helped a number of insurers in the region with their digital transformation. So I'm going to focus mainly on next generation AI-driven risk assessment on underwriting of life and health insurance policies. I think there's going to be a lot of overlap in this presentation with what Bob previously discussed and team. It's really interesting to see that there's a huge convergence, I think, in the insurance industry in terms of monolith systems, microservices, data management, use of models, use of data, trying to improve customer experience, trying to improve the efficiencies on internal processes as well. So I'm looking forward to discussing all of this with you. I think it's been quite apparent for a number of years that there's been this overarching sense that insurance is changing, and these are just some quotes from some of the lead consultancies out there going back as far as 2018, 2019. None of this is new. I've often discussed these quotes going back the last number of years. But what I am seeing and what we're seeing more and more is that the insurers themselves are actually communicating this sentiment. So this is just some outputs from insurers across the APAC region. I've masked the insurer names, but this is from a survey that we carried out over the last 12 months. And we can see that there's an overwhelming sense of convergence in terms of where their strategy lies and where data sits in that strategy. So some of these are really interesting. I like to see that this one, using digital to be personal, predictive, and proactive. So it's not just around using AI and using digital solutions to make existing processes more efficient, but at the end of the day, it's to try and improve the end user's experience. And there's a lot of use cases out there, particularly around underwriting, that you can kill more than one bird with one stone, in the sense where creating some efficiencies internally and creating efficiencies around your existing underwriting process has downstream impacts and upstream impact for both the end user, the customer, and also for other staff members like underwriters or actuaries or claims assessors and so on. So this is a real case study, and this is I'm going to focus on for the next couple of minutes. It's an insurer based in Singapore, where they engaged with Munich Re a couple of years ago, because they had a pain point, which was a low straight-through processing rate on their underwriting for life applications. So this insurer typically had an agent channel. The agent would use an iPad and visit the applicant, and they'd carry on and complete a medical questionnaire. The applicant then might hear back after a couple of days. If they were referred for additional evidence or referred for manual review, it might end up taking a couple of weeks before they would get a final answer. And they had a lot of feedback that this process was quite painful for the applicants. It's obviously was costly internally. You can see in this picture here that there was 33% of applications were processed straight through. By straight through, I mean that they went through the underwriting process without a human intervening, or without a human having to touch the case in any way. But 67% of cases went through manual underwriting. So this would be a combination of full manual review by a human underwriter. It could also be a combination of this along with evidence, and this evidence can sometimes be costly or can be time consuming. So just even breaking down straight through, from this 33%, we can see that 27 of these were accepted upfront, 5% were conditionally accepted, and then we've got less than 1% were either declined or postponed. It's actually interesting when you speak to different insurers in the region how they define STP as well, and straight through. I've noticed that some say that they only count the cases that have been accepted because these are the ones that they want to try and optimize the end user experience. So those that should be accepted up front, for those to be accepted, I suppose, as quickly as possible, instead of having to go down this route where in the end we can see here that from these 67% that ended up manually referred, 80% of these actually ended up standard. So this is actually 53%. This is 53% of the total. So this was a real standout for us, and we knew straight away that there was low hanging fruit. So by taking the historical application data and linking this with the final underwriting decisions and the outcomes from the evidence, we were able to build an ML model that could predict these cases that were more likely to be standard at an earlier point in time in the process. So instead of the cases having to go through this manual route and having evidence ordered, we were able to have a point of sale real-time model that was listening in on the questions being answered by the applicant, and providing a recommendation, not even a recommendation actually, providing an augmentation of the existing underwriting decision at the point of sale in real time. So this led to, I suppose, a drastic increase in STP, where not only STP, but we can see that the number of accepted standard cases more than doubled. And this has led to, I suppose, a lot of benefits for this insurer in the sense that they've got a lot of more new business, and more happy applicants going through the process much quicker. They're telling their families, their friends, that this was a really streamlined process, and they're getting more business, and also freeing up the underwriters. So I think a misconception is that by replacing or augmenting existing underwriting practices, you are potentially making underwriters redundant. But I don't think we've seen that happen in any of our use cases so far. What's actually happened is that those underwriters are freed up, and they can then process, for those cases that are coming to them, they can process them, I suppose, without having this huge pressure and workload sitting in front of them. So it means that the underwriters are working more effectively. They're probably, I suppose, assigning more of their, that there's a more consistent process in underwriting those cases, and it's not a big rush, particularly around certain times of the year. So just to reiterate the point again, and it goes back to one of Bob's points as well, that you know, there's a misconception that introducing AI models and microservices, you know, you need to completely overhaul your existing process. But where we see the real benefits lie in augmenting the existing process. So we like to augment existing underwriting and claims processes using responsible AI. So this is just a little bit more information. We did focus on increasing the STP, but from this increase, we also reduced medical evidence requirements. We improved the customer experience. There is, I suppose, the opportunity to look at new product initiatives as well off the back of this. Munich Re also reinsured this business and reinsured the new business taken on by the models. So therefore, the risk was quantified, and we were able to ensure that any error arising from this model was covered by Munich Re as well. So just overall, the approach was we developed a model on historical data, predicting the final underwriting decision. We were able to quantify and minimize the risk of AI through the support of our domain experts and actuarial team. We provided a comprehensive risk report to the insurer to help them with their own internal and regulatory sign-off. We were responsible for the deployment and management of the model, the integration of the model into the client's IT environment. The client had already used some Munich Re technology as part of their underwriting process. So we were able to augment that, I suppose, existing process with microservices. We implemented monitoring for real-time model monitoring and drift monitoring, and we were able to price and reinsure the risk. So what I discussed was I suppose a real case study where we have got hands-on with the insurer and helped them with a particular pain point. But this logic and this concept applies you know, for all, and we like to follow this path of 6 key steps. So initially you start with an AI discovery. And this really is to sit down with you, the insurer, and understand where your pain points lie. Can we help address and help with those pain points? Is AI or machine learning a suitable solution for those pain points? We like to understand what your understanding is of your KPIs, understanding what's the motivation for trying to improve particular KPIs or OKRs. And then we start to plot out a project, if you will. But I think the word project is even changing now and has some misconceptions. The outcomes and the outputs of a project involving an AI model is typically software, and it is really a product. So we see that this is a kickoff or an implementation project for us to help you build the AI solution that you will then integrate and implement as part of your existing product stack and your existing workflow. So after a project starts, obviously you need to get data and sourcing data from various systems, understanding which data is required. I'm just going to quickly step through for this case study what was involved. Were typically the data that we were looking at was the data collected during the application process, and the typical policy related information that's gathered from the applicants at application stage, the medical declaration form information, the base questions, the information relating to disclosures, the reflexive questions relating to disclosures given during the base questions. We also sought the insurer's back office data to validate and to derive the target features, and also to help in terms of us validating the risk associated with the errors of the model. So we can also see on the right hand side that there's free text and behavioral, image, and external data as well. So rule engine data is typically most rule engines that are being sold and distributed across the region are predominantly API based services. So the data is transactional. It may be stored on the client side, but typically it's not. It might be stored in a transactional database, and in its raw format, this data is either JSON or XML for SOAP based APIs. And in Asia, SOAP APIs are probably what we're seeing the most frequent because they were these solutions were implemented 10, 15 years ago, and that would have been the more predominant API-based communication back then. We are seeing more and more REST-based services now, but long story short, quite complicated nested data structures, varying data structures across different clients, large volumes of data, large file sizes, different types of data as well embedded in these XMLs. So we have created a pipeline that can process these XML type data from different rule engines, and we process this into a format that's suitable for building machine learning models. And we then create what we call, this is very generic, but a flat file, which is suitable for machine learning. So in the end, we receive hundreds of thousands of XML files, and we then process these and create a model ready file, and it looks something like maybe several hundred or even up to 1,000 columns with 500,000 plus rows, or each row representing a given prediction in our model. And once we've completed the data processing, we will then start exploratory data analysis. So the output of this would be a report given to the insurer, stepping them through what their data looks like, especially on those key KPIs that they're trying to improve with AI. And also during this process, we might try and validate some of the assumptions that we're hearing in the insurers. So, for example, during a discovery workshop, an insurer might say, well, we have an STP of 50%, we want to try and get to 80%. And it's at this is a key stage where we would actually validate and understand, first of all, are the insurer's assumptions true? Is their STP really 50%? How did they define the STP? What's their ceiling for STP given their distribution of final underwriting decisions, or even their claim experience, together with the risk quantification on the error. So I'm not going to go through each of these individually. It's just to give you a feel of the type of analysis we do, where we would identify correlations across different features. We do partial dependency and check reasonability across different features, and also seek to get domain expertise as well to help us with this. But it's the usual machine learning, data science process in terms of getting data, understanding data, and exploring the data before you go off and start building models. So once we understand the data, we have got to sign off that the data is reasonable. We've got to sign off on the deliverables. We would then start building a model for your use case. So again, we'd follow traditional machine learning and data science practices. I'm not sure what the audience makeup, but I'm sure that most of you have seen a number of presentations. You probably work with data yourselves on a day-to-day basis. You probably work very closely with data science teams. But typically, we take the historical data and we would split that into training and validation sets. The process involves training machine learning models, various machine learning models on that historical data to try and learn the patterns to predict a given target feature or target label. So in the case that I stepped through with you, we're taking all the historical data from the application, from the medical questionnaire, from external evidence, and we're trying to predict the final underwriting decision. And as you can see, it's not just a matter of building one model. We would build various types of models. We would try different feature combinations. We would simulate how this might look in the process flow. At what point in time would each of these models and each of these data feature sets be required? It's really important that this isn't done in isolation. So when you're building models, that you have a close loop with the domain experts, but also with the end user in terms of the insurer. Where will this model fit in the process flow? Will it sit before the underwriting engine? Does it need to sit in the middle of the underwriting? Does it sit after? Is it a batch process? Is it a real-time scoring? These are really key points, and they need to be tracked all along the project. Going back to the first slide, I think we saw that Gartner said that 85% of projects involving AI fell over in 2019, and the main reason for this is the fact that they fall over due to a lack of understanding and a lack of cohesion between the data science teams and the IT teams and the domain experts. So after building various models, we'd also rank the importance of data. We'd again keep the domain experts in loop, understand that our models that we're building is understanding the data the same way that the domain experts would. So for example, we'd seek to map data from the existing process, the application form, and map that to the features that we're using in our model, and understand, okay, so our model is ranking features based on how it sees them as being important. Does that, I suppose, match up with how our underwriters or our domain experts would also see this? So it's just further validation to ensure that we're on the right path. We're building models that make sense. Before we start real forward testing and any work on implementation or integration, it's really important that we get as much validation and sign off as possible. And again, I've already touched on this. Feature importance, partial dependency plots. The key point here is the fact that unlike descriptive analytics or business intelligence, data, especially when you're trying to build a model predicting, say, a binary classification, one might think that it could be quite simple to try and understand what the most important features are by looking at each feature one by one, maybe looking at some distributions. But in reality, it's a multivariate problem. An underwriter isn't taking one feature or one input and deciding what the outcome is. They're taking a range of outcomes. Rules in rule engines are taking, for one rule, say for diabetes, it's not just understanding if the applicant has diabetes. You're checking, their HbA1c. You're checking their age. You're checking their family history of diabetes, what medications they're on, and so on. So it's a real multivariate problem. And guidelines have been drawn up to be very multivariate in nature up till now, and it's important that we analyze data correctly and we use features as I suppose appropriately in models that we build to reflect this. And along with the feature importance, we also would look at the explainability and SHAP. Local explainability methods at the earliest stage possible to understand if this model was to go into production and we were to explain the reasons for prediction. Are these reasons reasonable? So I'm sure most of you have heard of SHAP, but it's just a method where you can use local explainability methods to understand which features contributed to a particular prediction from a machine learning model. So after we've built a model, we understand that we are meeting the expected KPIs. We've gained that extra 15 or 20% STP that's required from the insurer. We then would move on internally for a risk review and a risk assessment, and we'd work very closely with the insurer in terms of making sure that any doubts internally, compliance, even regulatory issues, maybe could be other reinsurers that are involved with the insurer, to make sure that any doubts can be clearly allayed, and also that we can clearly communicate the risk quantification associated with the error on any models we build. So we've built an internal calculator called IRA. At some point in time, we would like to expose this to insurers to use. But the idea here is that you have a flexible mechanism to change different thresholds, different criteria, understanding how changing different model inputs can affect the end-to-end KPIs, but also affect the end-to-end pricing and the slip-through rates. So this dashboard was created in collaboration with the actuarial team in Munich Re, with the data scientists, and it's quite a valuable asset. It's really useful for us and any projects with insurers. It really streamlines this whole risk quantification, because if you're doing this manually every time, it takes a lot of effort, and some insurers actually oversee this piece completely. So speaking with a number of other insurers in the region, they decide to do in-house data science projects. They're trying to build a pre-assessment model, or they're trying to build a model to flag out decline cases, or even to increase STP. They're completely ignoring this side of things, and when it comes to models being signed off by reinsurers or by the regulators, this is something that is really key, and the report that we would generate as well is very valuable in this sense. So another key point is responsible AI. So this is a key topic that has arisen over the last couple of years, and I'd say more so in the last 24 months since COVID. At Munich Re, we take responsible AI very seriously. Fairness, ethics, accountability, transparency, and we are an official MAS Veritas consortium member, and we're contributing and helping to build out and develop responsible AI principles and practices for insurers in Singapore. So responsible AI is actually quite a broad topic, and I think this is just a nice breakdown of some of the key pieces. So I think it's really important to make sure that models are fair, that we have tools in place, and we have monitoring in place to ensure that any ML models deployed for insurance use cases have sufficient bias detection and mitigation. And it is a contentious topic, because ML models are built on data that's flown has passed through your systems, or it's built on external data or experience data, or longitudinal data, and there is going to be inherent bias there. And I think it's a key to understand which bias is inherent in the data versus which bias is being introduced by the models. And even by introducing a responsible AI framework, it might allow you to understand if you already have AI, you already have bias, or you have unfairness in your existing process. And usually we are seeing that insurers do, and they're probably unaware of it. And I think that this is a real hot topic at the moment, and I think each market and each country are introducing their own responsible AI methodologies and recommendations, and very often they're going beyond being recommendations to being legally enforced, and having penalties and fines associated with breaches fairness and responsible AI. I've already walked through explainability and transparency, but that was mainly in the view of the development of models. Once models go live into production, I think it's really important to keep a view on explainability. Always have the ability to explain a particular decision to a stakeholder for audit, or even for an end applicant or an end user. Explainability is in itself, I think, a really key piece of responsible AI. Monitoring and governance, it's a broad topic again. I think the key piece is monitoring the models in production, monitoring model drift, monitoring data drift, and monitoring drift in general. And drift, I'll just give you a little walkthrough of what drift is. It's the process in which the input data has changed. So the profile of the data in which the ML models have been trained on has now shifted in production. So an example could be maybe airline models that have been built to predict which terminals would be busiest on certain days of the year. And during COVID, the input data has drastically changed. Something there has shifted, and that has drastically impacted how those models would predict the outputs. And therefore, that would mean that those models would need to be updated, or they need to be taken down because they would be incorrect. Another example could be Zillow in the US. There was a really famous case this year, or earlier, sorry, I think it was towards the end of 2021, where they had built an ML model that predicted the price, house prices. They actually had models that were buying and selling houses automatically without much human supervision, and it ended up being catastrophic for Zillow. Their models were built presuming that everything that had happened in the previous 5 or 6 years was consistent, and that everything would continue to go on like that. Despite the fact that there was huge quantitative easing, the S&P was heating up, the housing market was heating up. We'd only come out of a recession in 2008, 2009, 2010, and nobody had seen the fact that, you know, maybe we should be a little bit more careful with this model. But I think, yeah, these are just some key examples of where monitoring your models is really important. And I think it's the first step in understanding if there's something seriously going wrong, and having those appropriate alerts in place as well for key KPI. So it could be just monitoring KPIs associated with an AI model, or it could be monitoring the monitoring responsible AI, or monitoring drift. Each of these are really important, and I think that the earliest point possible at recognizing any changes here allows for quicker intervention and ultimately, I suppose, less risk in the long run. I'm going to keep moving on. So we also deal with deployment and integration. So for that use case I spoke through, that insurer already used Munich Re technology. So we were able to embed our predictive models through a new module called Predictor. So this was a kind of a module that allows seamless integration between the underwriting engine and our ML models. So the insurer does not have to worry about integration, or it doesn't even have to worry about microservices. It all happens under the hood, out of the view of the insurer. It saves them having to hire externals or hire or even use their IT resources to deal with integration with models. I've spoken about monitoring already. It's a topic close to my heart, and I think we've in Munich Re we've put a lot of work into our monitoring capabilities. So we have a suite of monitoring dashboards that monitor KPIs, models that monitors the model performance, monitors model drift, data drift, and the explainability. And we're in the process of building out a state-of-the-art MLOps platform that allows ongoing monitoring, maintenance, of existing models, the ability to quickly spin up and build new models on your data that's flowing through. And again, there's some huge overlapping topics with the last presentation. But this is just a slide to just talk through again how monitoring how ML models are extremely impacted by shifts in data, and how important it is to keep track of this in real time. So you can see this could be seen as the model performance over time. So if you have a static model that stays in place and you decide not to ever update that or retrain it, the assumption is that as time progresses, the input that was used to train that data in production, that no longer will be relevant. The profile of people is going to change, the business mix will change, the portfolios are going to change as well overall for all of our insurers. So it's really key to monitor, I suppose, to understand when this decay happens, why it happens, and then be able to intervene and republish, retrain models with the latest data on an ongoing basis. So it's not like we, deploy models one-off and we say goodbye, right? We want to be part of the process in terms of helping ensure that these models are something that can keep continuing to improve. They continue to be reliable, and they continue to be effective as well from a risk perspective. So this is just a little walkthrough of our MLOps platform. So this is a huge topic, again, over the last 12 months, and I think that we've been a leader in the insurance space in building out these key capabilities, and we've been doing this for quite a while. And it's all about ensuring the process in terms of building ML models and managing data, deploying models happens in a consistent manner, happens in a CI/CD manner, and we treat ML models like software. So we want to go through the same due diligence in building models as a technology group would in terms of building software. So we'd have data staging, we'd have proper UAT testing, we'd have regression testing, we have model management, code management. We've got the ability to collaborate with members across the teams. We have seamless model hosting, deployment, scaling, all of the monitoring capabilities, all available for the insurer to view and have access to. Integration with various rule engines, claims engines, back office systems, microservices. This is what we're building now, and it's currently in development. So I suppose watch the space and hope that we'll be able to share more about this in the future. So aside from the use case I stepped through, there are other success stories in the region. I did speak about the Singaporean insurer where we increased STP by more than twofold. And this use case, I think, resonated with a number of other insurers in the region, and we've also had success in terms of building a similar solution for an insurer in Malaysia, where we increased their STP by 1.7 times. So I think their STP to begin with was around 40%, and we were able to increase to over 60% as well. Also a client in Vietnam, yes, we were able to similarly increase STP and also quantify risk, reduce medical evidence, improve that the end user experience by deploying these models and having them available in real time, having our rule engine interact and augment decisions in real time through microservices. And the last one is a South African insurer. It's probably not as relevant for the audience on this call, but yeah, we were able to help build out a process where 50% of applicants qualified for a new SIO product at fully underwritten rates. So we were able to use AI and ML models to build out the, I suppose, the required analysis that enables the insurer to do this. And this is something that we constantly look at as well. It's not just about building models and deploying them in real time or batch. We can also use models to help build out new product offerings, help insurers understand maybe some bottlenecks in their process, how to improve their existing processes as well, instead of having to say, come in and introduce new integration points in their system. So I think just given the use case we stepped through, I'll try and go through this quickly. So we have, this is the typical scenario we see in the region. Now, STP rates do differ. Some insurers will say their STP is 70%, but when you start looking under the hood and when you start seeing that there's, okay, it's 70%, but that's ignoring admin rules, or it's 70%, but it's ignoring something else, right? We're typically seeing probably STP of between 40 and 60% in the region. And for those on the lower side of that, I think it's a really a compelling use case, augmented underwriting. And this is just a step through of some of the other pain points that's associated with this low STP. So insurers that have this low STP most likely have all these other pain points as well. So with the low STP, they've got a lot of applicants referred for manual underwriting. Most of these should have been standard, but essentially they're having to go through the exact same process as somebody that's been declined. We have too many questions in the app form. We have anti-selective behavior, potentially been driven by agents. Maybe there's non-disclosure by the applicants. BMI and smoker disclosure is something that we're seeing as something that is an issue in some markets, and we're building solutions to help deal with this. Unnecessary reflexive questions. So this has a number of different perspectives here. Again, for the user, it's similar to those application questions. It's just that these are more granular, more detailed questions. There's a maintenance impact here as well for the insurer. They have to maintain these questions. They have to maintain these rules. They have to have staff dedicated to maintaining these question sets. Medical evidence requirements. Again, it's impacting the end user. They have to go get bloods. They have to go provide a urine sample. They have to go see their doctor. And sometimes they don't need to do this. So it's really important that we can use ML models to try and flag out these candidate applicants that potentially don't require these additional medical evidence. Handwritten doctor reports, lab results, scans. Again, it's unstructured data. We are seeing an improvement. More records are being digitalized, but the reality is in the Asia market, we're still seeing a lot of paper, a lot of handwritten notes as well, a lot of reports of different types of formats, and quite difficult to digitalize. A lot of insurers looking for OCR solutions to help with this. Again, there's a lot of limitations on that as well. So we're helping in this space as well. Again, it's just a repeat. There's a lot of time and effort associated with referring cases to underwriting. So yeah, so the main benefits that we want to target, I'm repeating myself a little bit here again, but it's to have shorter onboarding time, minimal questions and evidence, increasing STP with acceptable risk, increasing underwriting capacity, increase accuracy of risk selection through new data sources, reduce referral processing effort, reduce the cost of underwriting, improve profitability by reducing the impact of anti-selection, and being able to audit at scale as well. So this is kind of a future or maybe near future scenario that we see for a lot of insurers in the region. Some of our ongoing projects are working towards this, where you've got this data ecosystem. Again, there's some overlap with what Bob has mentioned, but there's data from various sources, external data, you've got unstructured data, wearable data, back office data, behavioral data, and the kind of traditional data, all being captured at different points in time in a process. And we will then like to have the existing underwriting process augmented with the use of various augmenting microservices. So those could be to help with fraud or anti-selection, misrepresentation, increasing automation, having more personalized underwriting for the user, By that, I mean picking the questions that are most suitable for that applicant instead of having a hard-coded process, leveraging third-party data and AI scores, claims automation. So being able to, I suppose, going through the claims adjudication process more effectively and more streamlined. I have been focusing on underwriting for this presentation, but we also work with claims use cases as well. Again, this is just another view of this with more detail. We can see that there's a number of these different potential use cases available. I think these are things that insurers are thinking about. They're speaking with external vendors. They're speaking with us. They are spending time internally to validate and understand these new technologies, especially around BMI prediction on face image. We've built our own model that's been validated internally. It's really exciting. We've also been spending time building out capabilities in terms of predicting vital measurements based on video. We hope that we can start introducing these services as part of our augmented underwriting suite of products. Early claims and non-disclosure prediction. These sometimes go hand in hand, but not necessarily. I think it depends on the type and the nature of the products. For health type products, there is a lot more claims, obviously, but it gives us the ability to also focus in on those that are costly claims, or for those applicants that are claiming more than they should. Why weren't these priced accordingly at underwriting? Was there non-disclosure? So it's the ability to flag and tag these kind of scenarios at the point of underwriting, but also potentially after a case has been issued as well, and you can look back. Agent behavior detection. So I have mentioned gaming and anti-selection. It is an issue in some markets where the agents are pushing applicants through a particular route, knowing that they have a higher chance of getting STP, maybe gaming and maybe nudging the applicants to not give correct answers in certain cases and in certain extreme cases. So we've been able to identify this behavior. We've been able to build some models that can detect this behavior in real time. So we see that this augmented underwriting vision would combine all of these different types of models at the point of sale during the underwriting process, and combine this as well with potentially a human in the loop, and provide a better experience for the end user, and also reduce risk for the initial opportunities where you have models running potentially after issue, looking at maybe batch processes where you could identify applicants that are suitable for a particular new product. Maybe there's a cross-sell, upsell opportunity, looking at propensity to buy, looking at lapse prediction. Even I'd say some of the early claim prediction models are also relevant here as well. So yeah, we'd like to think that we can fit and help insurers increase and augment efficiency across the value chain. So this is just a more detailed look at one of these. I'm not going to step through this. I think I am getting short for time at the moment, but this is just to give you a little bit more, I suppose, depth in terms of what a use case might look like for an insurer by implementing a number of these different models. So this is just a process flow where we've introduced a pre-assessment model to try flag out cases that are suitable for simplified underwriting. Then we have a second model that we have a limited set of questions for applicants first to understand. With this limited set of questions, we're giving the applicant a better experience. Can we provide a prediction based on a limited set of questions? And if not, we would then proceed and ask the remaining set of questions to the applicant because we know they are higher risk. We then have an anti-selection non-disclosure model that would flag out and understand, is their BMI in line with what we'd expect? Is their smoker status correct? Maybe there's a couple of key risk factors that we would also check to see that there's alignment. Say, for example, the applicant may disclose a family history of high blood pressure or high cholesterol or heart disease, but in their own application, they've, maybe perfectly clean. Maybe their risk profile, maybe they're, 50 years old or got a BMI of 28, 29. And there's a lot of key indicators there that would indicate that, maybe there could be some non-disclosure. So it's a really interesting use case to have that at the point of underwriting and be able to flag that out for the insurer. Risk scoring, then using the full set of features. This is the traditional case of just trying to improve STP. In general, we can have scoring then for those cases that are referred to underwriting. We can have a triaging or models that can help the underwriter and enhance their experience. So it could be recommendations for the underwriter based on the data that's flown through the system. And finally, then we have these other models that are running after issue, predicting cases that might lapse, predicting those that are more suitable for new products and so on, like I'd already discussed. So I hope you're able to follow me on all of that. I did rush through some of those slides, but I think I've been able to hopefully clearly show how we've been able to add value for a number of insurers in the region, especially that use case for the insurer in Singapore that I walked through, where we doubled their STP. So this is just the same slide again. So if any of you are interested in reaching out, I'm happy to I suppose be in contact after this, or happy to take any questions. But yeah, we offer a complimentary discovery workshop. So this workshop that I'd previously mentioned, it's where we sit down with you. We understand, can we offer you value? We might showcase some more use cases that go beyond what's been presented here. We get to see and understand your pain points, and we get to know and understand if AI and ML solutions are really viable for you, because in the end there's no point introducing an ML model or AI model just for the sake of it. And I think that we're starting to see a little bit more realism in this sense, where we've spoken with lots of insurers that they've tried, and maybe for 4 years, 3-4 years now, they've been spending money and they're trying to fix a particular problem. And in the meantime, they've actually been able to fix the problem themselves just through incremental improvements, better processes, better teams working together. So I'd like to finish up there. Thank you very much for listening, and thanks a lot for having me today. Thank you.
Okay. Yeah, thank you for the presentation, Ryan. But unfortunately, we are running out of time. So I think we will discuss only one question. Later on, if there is another question, we will email you, okay?
Yep.
So this is the question from Bapak Ari Agustiansa. Currently, the development of AI is very fast. Will AI can do what actuaries do in the future, like reserving, rate making, and so on?
It's tough to say. I think for definitely there'll be ML. I think the data science and the actuarial world is going to start converging. I think the new actuaries coming out now, and are becoming newly qualified, have data science experience, and like they're able to build models. So I see wherever there is potential to improve existing processes, remove technical debt, remove any bloat in processes. Definitely, I think machine learning models can help. It may not replace, but again, I see a similar process as underwriting, where the existing processes will certainly be augmented with models for sure, and maybe some parts of reserving or pricing might be replaced by by ML models.
Well, okay, thank you for the answer, and thank you so much once again for your presentation. All the best for you, and stay healthy. Okay.
Thank you.
Thank you.
Thank
Yeah.
you. Bye. Thank you very much.
Okay. Yeah. Okay. Thank you everyone who have attended and participated. Now we will have closing remarks. It will be addressed by the Vice President of Persatuan Actuaries Indonesia, and also the Committee Chair of Society of Actuaries Greater Asia. So let's welcome Pak Paul Kartono.
Okay, thank you everyone for attending the seminar. I think I would say that this seminar is a success. This is the first time that jointly collaborate between SOA and PAI. So I think congratulations to all the speakers and all the committees that I think this is very successful. I think the attendees are more than 200 and stay until the end. I think it's a great achievement. I think we will expect that there will be many more to come. Collaboration between the SOA and also the PAI, so that we can increase our knowledge. So first slide, please. Next. So I would like to thank you formally for the presenters, Bob, Charles, Kaesong, Amos, Nicholas, Debbie, Nadia, and Jogan for the great presentation. I saw that in the chat as well as in live, there are many questions being asked. So that's a good sign that the participants are listening to your presentation and with very much enthusiasm. So I think we can this topic is very interesting and we can elaborate further in the future. So in this closing remarks, I would like to also introduce some of the key developments and changes in the SOA and also for the PAI, because as mentioned, I work in both SOA as the chairman of the committee of the Greater Asia Committee, and for the PAI is the deputy president of the PAI. Next. So there are now changes in the ASA pathways, and there are micro credential on the pre-actuarial foundation, actuarial science foundation, and data science for actuaries. There are the micro credential that is slightly changed from the previous pathway to get into the ASA. Now it's a bit changed. I think there are also, for you who pursuing the SOA designation, either ASA or FSA, there are also changes in the FSA and ASA module. So please keep in touch so you are not being disadvantaged after the change. So I think that is very important. Next. We also extend the membership to affiliate member. So all the candidates can join. No requirements to maintain membership as the professional development and anything for the affiliate membership. And no specific codes of conduct tie up to the membership. I think the only things that we need to obey is the candidate code of conduct if you are coming join the membership of the SOA as the affiliate member. Next. The benefit of the affiliate member is, as you can see, digital library and on-demand learning. I think there are a lot of podcasts, everything, books, research, growing community, also live virtual events. They are paid and free. I think there are virtual events hosted by the SOA, and also short-term flash mentoring or one-on-one coaching, and also assistance navigating the university or exam process. I think they are the benefit of becoming the affiliate member of the SOA. Next. This is also same for the micro credential. No requirement for ongoing professional development to maintain the membership, but you need to pay the dues, which is less than $100 per year. Next. The benefit of the professional affiliate is you can access all the podcasts and technical skill webcasts, peer-to-peer networking, invitation to exclusive career development events, leadership advancement opportunities. There are also career posts there, and also unique volunteer opportunities. If you would like to be volunteer, either writing an articles or become the committee for the seminar, anything, please welcome to join for the SOA professional affiliate. As the SOA, I think we develop also look at the market, and based on the demand, we create the FRI certificate product. So this is an in-depth training for the IFRS 17 for the insurer, and this is in the form of study, virtual study, as well as thing face-to-face. So this you can register if you want to become the certificate of the IFRS 17. I think for the young actuaries, this can boost your career. As you know that IFRS 17 people, especially the actuaries, are in very high demand right now, considering that the 2023 will be the first day implementation for the international, while for Indonesia is 2025. So this is one of the programs that you can consider to join. Next. As also the theme of today's seminar is regarding the digital and AI. This is also to connect the actuarial world into the AI, digital, data science world. So this is the predictive analytics certificate program. I think this is if you take this certification, this is also open up your career opportunities way much bigger, because then you are merging, you are as an actuary that knows the actuarial mathematics and also have the huge code of ethics and code of conducts, as well as you also know the knowledge by certification of the predictive analytics. Next, this is also a framework that you can create, that there is an ethical and responsibility use of data and predictive model certificate program. So the difference between actuaries that knows the predictive modeling and the pure data scientists that learn from the YouTube or everything is that the actuaries has the ethics and responsible and code of conduct. So it set us apart as a profession with the other that only know the knowledge but doesn't into the profession. This is the context for the SOA. You can create the staff and the team of the Greater Asia Committee from the email above, or you can contact the Greater Asia Committee members for Indonesia. For Indonesia is now represented by myself and also Yudis from AXA. This is the website. We have Asia website and we separate Asia website, and we also have Facebook page for the Asia SOA Asia. Next one is for the progress and next event for the PAI. This is also what we expect, that this is in Indonesia. Now we already upgrade our database system and also upgrade our management of the CPD point, so that you can monitor and collect, and it is automatically connected with the regulator, with the P2PK, and also easier to pay your membership dues and follow exams, seminars, and also workshop. Next. This is the screenshot of the apps. So you can download the apps from Play Store and App Store. You can download the apps. So there is all exam registration, payment of the membership dues, and everything is in there. Just flip through the page aja. Next. This is the screenshot of we have now the apps. Next. And this is the reporting of your CPD. It is online and directly connected to the regulator. Next. Next. So it's now directly connected to the P2PK, so you don't need to create the separate report for the P2PK. Next. This is the next event that we are all expecting for the PAI. One is the launch of the new morbidity table, the first morbidity table for critical illness in Indonesia. I think it's already finished. It is just on the final review. So hopefully we can soon launch. And for the fellow members and also public actuary, we are expecting you guys to join the summit. That will be, announcement will be announced soon, but you can save the date that it will be in the 3rd week of September. And a bit of teaser, it will be in Lombok. So we will have also the joint regional seminar, then a financial expo, and many CPD events coming up. Thank you. I think that's all my update. So if anyone would like to ask, I can take 1 or 2 questions if there is a question. Thank you.
Okay, thank you, Pak Paul. So, is there any question from the audience? Mungkin dalam bahasa Indonesia juga tidak apa-apa ya, Pak ya?
Ya, nggak apa-apa.
Oke, please.
Dan nanti jangan lupa isi survei, karena survei sangat penting untuk kita meningkatkan konten di event kemudian dan juga untuk pelaksanaannya.
Oke. Ya, nampaknya belum ada, Pak.
Oke.
Oke, ya, sudah mungkin Pak Paul ya?
Ya, oke.
Baik, terima kasih atas Pak Paul atas closing remarks-nya. Oke, dan sebelum kita mengakhiri sesi webinar hari ini, seperti biasa ya, kita akan melakukan sesi foto bersama. Untuk itu, kepada para peserta, silahkan dinyalakan terlebih dahulu kameranya. Oke, for the participant, please turn on your camera because we will have a documentation session. And it's just quick, okay? So maybe we will do for 3 times, okay? Ya, mungkin bisa dibantu Mbak Leoni, oke? 3 kali ya berarti ya, oke? 1, 2, 3, oke, senyum semuanya.
Rasanya tidak akan mungkin.
Oke, thank you. 2 more times. 1, 2, 3. Oke, terima kasih. 1 kali lagi. Oke, 1, 2, 3. Oke, terima kasih. Oke, so I think that concludes our webinar today. Dan mohon maaf Bapak Ibu para peserta karena memang di jalannya webinar kali ini, di jalannya webinar hari ini mungkin banyak kekurangan. Kami memohon maaf dalam kesalahan-kesalahan yang kami buat. Dan sekali lagi terima kasih atas partisipasinya. Semoga sehat selalu dimanapun Bapak Ibu berada. Terima kasih. See you in the next event. Thank you. Bye-bye.